Fun, fun, fun. All right, so to register, if you haven't registered for my online study, go to my website, lgdconsulting.com. On the top right-hand side, there's a programs and pricing link. Click on the PayPal link next to the course that you want to register for. If you are with a company, on the right-hand side, there's a couple company names that are hyperlinked. And there's a discount price for agents that work for specific companies because they send me quite a few people, so I give them a break. If you do have questions after this webinar is over, this is my cell phone, 925-852-9641, or you can email me, lauren@lgdconsulting.com. While you're studying, if you do have questions, again, reach out to me. Don't Google terms, use Wikipedia, or ask your coworker who got their license 20 years ago. Don't ask them questions about the material because they're going to give you a general different definition of what you need to know to pass this test. So reach out to me. As you can see, my webinars are in the evening, so I'm not like a 9 to 5 guy. So evenings, weekends, if you do have some questions, don't hesitate, pitch out an email. Some of you are texters, the millennials. If you text me, expect me to give you a call back. I'm not going to text, 3 paragraphs of information, just so you know. So when you do text me a question, expect me to, just give you a call back and answer your question. So, but we'll go on, okay? All right. About the exam, it's 150 questions for the life and health. Those of you doing the life only, it's 75 questions. In either case, you have to get 60% correct to pass. That's like a D. The 150 question test, you have 3 hours. For the life only, you have an hour and a half. That's plenty of time. If it takes you the whole time, I'd say you weren't quite ready. You don't have to rush. But again, 3 hours for 150 questions is a very long time. Okay. If you have not registered for your exam, you want to go to psiexams.com, set up an account, and schedule your exam. Most of you will probably be taking it at a PSI site. It's an outside vendor that the Department of Insurance is contracted with to give you some test locations. If you're in Sacramento, Los Angeles, or San Diego, then you go to the CDI site. Those are limited. Those are Department of Insurance locations. If you take the test at the PSI site, it's $83 to take the test. That means if you fail it, that's going to be your retest fee. But if you go to the CDI, which is California Department of Insurance site, it's only $50 to take the test. But again, that's Sacramento, Los Angeles, and San Diego only. And so if you did fail, that's a $50 retest fee also. When you schedule your test, make sure you show up 20 minutes early. If your test is scheduled at 1:30, it's going to start at 1:30. That means you need to check in before 1:30. Bring a valid ID. So if your driver's license expired 2 weeks ago, they won't let you take the test. So it's got to be current. When you pass the test, if this is your first license, they'll fingerprint you after you pass the test. So you want to sign up for the fingerprinting. It's convenient to get your fingerprints done at the test location right after you pass. Again, if you go into the California Department of Insurance location or CDI site, that's going to be $58.30, all right, to get fingerprinted there. If you're going to the PSI location, it's going to be $68.95 to get fingerprinted there, okay? Same live scan machine in either case. The PSI company, they're an outside company, a private vendor, and so they're going to charge a little extra so that they get paid for their work. That's what that is. So that's what the difference in the pricing is about, okay? All right. For this exam, you got to be prepared. You got to go through my material on my website. Okay. You can't just do 1 or 2 exams off of my website and think you can wing it, even though you only need a D. It's a tricky D. So you got to watch out for that. When you're taking a test, breathe. It's just a test. Now, you've taken many tests during your lifetime. This is just one more. Right? Don't impose undue stress on yourself. Just relax, take a deep cleansing breath periodically. If you need to, get up and stretch. Again, 3 hours is a long time, so just to give you a heads up. When you get to a long question, whoops, I passed one. No parking. No parking means if you're at this question while you're going through the test and you're reading it like 3, 4, 5 times, stop. All right, pick your best guess. Write the question number down on your scratch sheet and move on. Okay. I don't want you to park because that's going to just create undue stress reading this question over and over again. If all else fails, maybe get up, take a quick stretch, and then sit back down, take another look, read the question, read the answers, pick your best guess, and move on. All right. Write the question number down on your scratch sheet. All right. At the end of the test, after, when the majority of the test is over, you have this little bit of a weight lift that, I'm through with it. So then you can go back with a little bit of a clearer mind, take another look at that question. Okay. So don't search. I do want you to answer it though. Okay, so don't use the skip or flag, which is like 2 bullets down. I don't want you to use those buttons. Either you know the answer or you don't. If you don't know, pick your best guess, write the question number down, and move on to the next one. Okay. When you get to a long, I'll give you that explanation in just a second. When you get to a long question, start at the bottom, read the answers first. Kind of see it what the question is getting to. Then honestly, I would read the question just before the answers. Don't read that whole paragraph of what the test question is. The question right above the answers is probably going to say which of the following is a correct statement or which of the following is an incorrect statement. All right, that's what you want to go after. Because a lot of that language in the exam is useless knowledge, just useless information, just additional information. It doesn't help you get to the answer. All right. Tricky verbiage. A lot of this test is not really testing your knowledge. It is to some extent, but most of it's just making sure you can read this question right to determine whether they're looking for the right answer or the wrong answer. Okay. So again, don't use the skip or the flag. If you do skip and you, if you use skip and let's say you're moving slower than you thought and you run out of time, the test closes out and those ones that you skipped, they're counted wrong because you never answer them. That's why I'm saying pick your best guess, write the question number down, and move on. That means if you run out of time because you're moving slower than you thought, at least your best guess is logged in, and that's what you want to do. And don't use the flag, or sometimes you'll see mark for review. Don't use those either. Either you know it or you don't, okay? So the next bullet, you got to trust yourself. You trust that you studied, you put in the time, you studied the sample test questions to prepare yourself for this exam. All right. And again, watch out for the excepts and the nots. This test does have a few double negatives. All of the following are incorrect, except which of the following is not unlawful. Okay, so it's a kind of a language that we normally don't speak. And again, this is going back to what I said earlier. It's more of, can you read this question or interpret this question to figure out, are they looking for the right answer or the wrong answer? So be wary of that. So the test is passable, folks. Trust yourself. If you're like me, I've met people in the industry that have their license, and I look at them like, how the hell did they pass their test? So, and you might have met a few too. So, I mean, have some faith and trust yourself, but you got to put in the time, okay? So let's talk about some definitions. The first one is insurance, which is what this is all about. You may get a couple variations of how they're going to ask, what is the definition of insurance? Insurance is, and then you might get just a one-word answer, it's a contract. Okay, it's a contract to indemnify someone, or you might get the full-blown definition. It's a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. Okay, so I don't know which definition you're going to get or which answer they're looking for, but know those three. Those are the ones that are very common, and you'll probably get the definition of insurance at least twice on the test. You might also see it attached to California Insurance Code 22 or CIC 22. They're not going to ask you what does California Insurance Code Section 22 mean. Okay, it's going to say the definition of insurance, which is found in California Insurance Code Section 22, states which of the following, and then you want to pick your answer from there. Okay, so it's useless additional information. It has nothing to do with it. It's just the definition of insurance is a contract. It's a contract to indemnify you, which is the next one. Indemnity means to restore you to what you had before a loss, all right? To make you whole again. And so if someone suffers a disability, they're unable to work, to indemnify them, we're going to replace a missing income that they would have normally worked if they were up and running and working and creating an income, okay? A lot of times there's more in the property and casualty field. If you have a 3-bedroom, 2-bath house and the house burns down, to indemnify you, the insurance company will cover the cost to rebuild the exact same 3-bedroom, 2-bath house, because that restored you to what you had before the loss. We're not going to build you a 5-bedroom, 3.5-bath house because that improved your condition. That was a gain, and that's not what insurance is about. Okay, so indemnity means to restore you to what you had. Now, if someone passes away, we can't replace the person. But there's two different approaches we can use to indemnify or replace their income. Number one is the human life value approach. And this is going to look at a couple items. Number one, how much does this person make a year? How many years do they have left to retire? The capitalized rate, which is the value of the dollars that depreciates over time. And also, what expenses become apparent should this person pass away, like cost of burial. So under the human life value approach, if an insured dies, we can't replace them, but we can replace the income that they would have normally brought into this relationship if they were still alive and working and creating an income. Okay, that's human life value approach. The other approach is the needs approach. And that's looking at the needs of the beneficiary. How much money does a beneficiary need to maintain their standard of living? To cover mortgage, cover their mortgage, cover their living expenses, put money in a college fund for the kids. That's looking at the needs of the beneficiary. So watch those questions. One's looking at income replacement for an insured, and the other one is looking at how much do the beneficiaries need to maintain their standard of living. Okay. Loss, and going back to insurable interest. Insurable interest is having a legitimate economic or financial interest in the preservation of the life of the property that is a subject of the insurance. That's a long definition, but you may get that on the test. Keep it simple. In order for you to buy insurance on someone or something, if that someone or something were to suffer a loss, financially, you're going to be affected. So you can insure your house, because if your house burns down, you're going to be affected financially because you got to pay for the cost to rebuild it. All right. Likewise, if you damage your car, if you break your arm, well, there's a financial interest because you're going to have to cover the cost to go to the doctors, get it x-rayed, set, cast, and let it heal. Okay. And so there's a financial or economic interest is what the test uses in yourself. Okay. You could not buy a life insurance policy on your neighbor. Now, if your neighbor passes away, emotionally might be distraught because they were like really cool people, but financially, there's no effect for you. So if there's no financial or economic interest, you couldn't buy a policy on them. In life insurance, you only have to prove insurable interest at the date of application. That's when the insurance goes into effect, okay, not afterwards. In the property and casualty world, you actually have to prove insurable interest twice, when the policy goes into effect and when the loss occurs to collect. Okay. In buying a life insurance policy, the beneficiary does not have to have insurable interest. For the California Insurance Code, make sure you understand that. The beneficiary does not have to sign off and acknowledge they're a beneficiary. They do not have any insurable interest. They don't need to. As a single individual buying a life insurance policy on yourself, you can name anyone in the world as a beneficiary. All right. So the beneficiary does not have to have insurable interest. All right. Loss is defined as a reduction in the quantity, quality, or value of an asset. The loss doesn't have to be great, but for the test, there's got to be a financial attachment to it. Okay, so that kind of goes back to having an insurable interest. Okay. Risk is defined as uncertainty of a loss. There are two types of risk we need to familiarize ourselves with. Number one, pure risk, which is possibility of loss only, which is the only type of risk we can insure. There's speculative risk, which is possibility of loss or gain. Equate that to gambling. When you go gambling, you can win money, you can lose money. Well, if you can win money or get a gain, I should say, then insurance, we won't insure it. We only insure the loss. So as much as you could afford $1 million policy on a brand new baby, the insurance companies will probably not offer you the coverage or allow you to buy that much. Okay. Nobody should outlive their children, but if they do, you get $1 million to go take a vacation, that improves your condition. So the underwriters look at that, and so they limit what you can buy. You have to show proof that the situation warrants a higher face amount. In the real world, most people can only insure about 15 to 20 times their annual salary. So what newborn baby has an annual salary that allows you to buy $1 million worth of life insurance on them? You see, that's kind of going for a gain. And by limiting what you get, it reduces the likelihood of fraud. So yeah, just to give you heads up. A peril is defined as a cause of a loss. You may, if you're lucky, get one question on peril. On the property and casualty test, you'll get a lot of questions on perils. Okay, but peril is cause of a loss, like cancer or AIDS. They cause loss. A hazard is a condition that would increase the likelihood of a loss or a peril occurring. And so let's say an auto accident, that would be a peril that causes loss. Physical hazard would be you have badly worn tires on your car, which increases the likelihood of you having an auto accident. Okay, so a hazard increases the likelihood of a loss occurring. Right? Moral hazard ends with an L. That's why I put in red. Moral ends in an L for lie. And people lie to your face. I was training some agents today, actually, and they had one of their prospects already lying to them. For auto insurance, they're going to lie to your face, because when you ask them, hey, have you had any tickets or accidents in the past 3 years? They're going to say no. And then you look it up and they've got a couple items there which causes the rate to go up. Okay. It is what it is. People are going to do that. So they're hoping it doesn't show. So moral ends with an L for lie. Morale is carelessness, indifferent attitude. So think of more ale. When you drink more beer, you get careless and clumsy. You got that liquid confidence. You probably do stuff you probably shouldn't do. Okay. So that's another type of hazard. So lying, cheating, being dishonest is moral. Having an indifferent attitude, careless, reckless. Someone who drives fast, they go skydiving, they're putting their life at risk. That's a different mindset. And for the test, they call that an indifferent attitude. Okay. Another type of hazard is a legal hazard. Someone who suffers a loss and is going for more money than they're legally entitled to. On the exam, they'll use that for disability income. Someone suffers a disability, they're healthy, but they drag their feet in going back to work. The test will say something like they malinger after a claim. That means they're not in a rush to go back to work because they're making the same money at home playing PS3, okay? Or maybe they upgraded to PS4. So, but that's a legal hazard. People that are going for more money than they're legally entitled to. Now, either the company pays the claim, they defend the claim, or they might offer a settlement. But in either case, it costs the insurance company money, and that increased cost of that claim, or the defending the claim, or offering a settlement, comes from all of us paying higher premiums. So legal hazards, those people that are going for more money than they're legally entitled to, we are all paying for it with increased premiums. Okay. All right. So there's some of the definitions. We'll go through quite a bit more as we go through this program. All right, so here I'm going to quiz you a little bit, but select from the choices below the best description of a speculative risk. And we kind of just talked about it. There's a possibility of a gain, also the uncertainty of a loss. So speculative risk would be gambling. You could win money, you could lose money. Okay, so there's a difference in how I present it. You can get a gain, a loss or gain, but the test, the verbiage changes. So if you don't go through sample test questions that are similar to the test, those of you that do the online training, a lot of it's very general. It's the same exam that they use across the country, which is pretty straightforward. But here in California, they have their own test writers. So this test is a little bit different as far as the verbiage and the terminology. So by going through my questions over and over again, you'll get used to it, and you'll recognize the little tricks they put in the program. The best description of a hazard is, and it's a condition that may increase the chance that a loss may occur. So B is defining cause of a loss, which is a peril. Pure risk is loss only. And D is just defining risk, which is uncertainty of financial loss. Okay. Choose from the following selections the best description of a premium. This one's a really good question. The answer you want to know is how much you pay for the insurance, right? You buy coffee by the pound, you buy gas by the gallon, you buy insurance by the unit. 1 unit of insurance is $1,000. So $7 for every $1,000 of coverage. That would be the premium. But if you look at the answer B, funds received by an insurer from an insured to realize the benefits of the policy. That sounds like it could be the premium, but be wary of it. That's actually defining a deductible. So it's how much you have to pay to realize the benefits, which is the claim of the policy. And so that would be a deductible, like in health insurance. Okay, so I mean, it looks kind of good. So in a sense, there's like 2 right answers, but one's a little more correct, and that's the one I have highlighted here. Where is insurable interest required to exist with a life insurance policy? And like I said, you only have to prove insurable interest one time at the date of application for life insurance. In the property and casualty world, you have to prove it twice, date of application and at the time of the loss. Okay. Types of insurers. The first one we're going to talk about is a mutual insurance company. This is where, in a sense, the policyholders own the company. And so you, the policy, as you can see on the left-hand side, you're going to pay premium to the company. It's after-tax premium because it's an individual policy. The premiums are not tax deductible unless you donate the proceeds to charity. All right? So in most cases, you're going to use after-tax money to pay for the policy. The company's going to use that money. They're going to go through their accounting process. And if we actually make a profit, then on the right-hand side, we're going to give that money back to you if we overcharge you, and we're going to call it a dividend. All right? Dividends are non-taxable because you're using after-tax money to pay for the policy, and we're basically giving you after-tax money back because according to the IRS, dividends to a policyholder are defined as a return of excess premium paid. So again, after-tax money to pay for the policy, you're paying $10 a month in premium, let's say. It only costs $8 to insure you. So we overcharge you by $2. We're going to give it back to you, and we're going to call it a dividend. Okay, that's what that's about. So mutual insurance companies offer participating policies. And how you want to understand that is the policyholders participate in the dividends from the company. So a sample test question will look like this. Sam's insurance policy pays a dividend. So that tells you right now that the policyholder gets a dividend. So it's a mutual company. But the agent that sold Sam the policy refers to the shareholders of the company as participating, which is another, again, a hint that it's a mutual insurance company. That's how that works. Now, a stock insurance company, which is the biggest competitor, you pay premium. It's still after-tax premium being paid to an insurance company, but a stock insurance company is owned by stockholders, shareholders. That means if this company does well and makes a profit, that profit is paid as a dividend to the stockholders or shareholders of the company, not the policyholders. Okay, and so stock insurance companies offer what's called non-participating policies because the policyholders do not participate in the dividend. You just got a policy. So they could reword this question: Sam's insurance policy does not pay a dividend. The agent that sold Sam the policy refers to the policy that the company offers as non-participating. Therefore, it is a stock company. Okay. Now, on the test, if you see commercial insurers, those are our stock and mutual insurance companies. Those are the commercial insurers that you'll have. All right. There's other types of insurers, but these are the main ones that you need to understand. Okay. All right. So Julie is a licensed insurance salesperson who represents the Silver Dollar Insurance Company. If you were to look at the front of her office, you would see a sign that reads Silver Dollar Insurance Company and Julie Insurance Agency. So if Julie performs acts that are not specifically named in the written contract she has with Silver Dollar, she is exercising her what authority? So if it's not specifically named in the written contract, that's going to be an implied authority. Implied means not in writing. All right. So express means in writing. Implied means not in writing. Okay. So now they can change this where she's doing something that's in writing, and that would be express. So, I mean, the question is pretty much the same. It's just, is it in the contract or is it not? Okay, so. Okay. All right, so always remember that. Express is in writing. Implied means not in writing. Okay, not verbal, just not in writing. All right, so keep that one in mind. Random question. The Federal Act that mandates that a credit reporting company responds to a consumer complaint when the company's credit report inaccurately reflects information about the consumer is known as, and that's a Fair Credit Reporting Act. You might see actually the acronyms FCRA, Fair Credit Reporting Act of 1970. This is your right as a consumer. If there's a blemish in your credit report, you can request the credit reporting agency to investigate it and clean it up if it doesn't pertain to you. That's your right as a consumer, and that's free. Okay. Agents versus brokers. First of all, it doesn't say life or health in the name. So when you see insurance agent, insurance broker, think these are on the property and casualty field. These are people that do auto, homeowners, commercial, workers' comp type coverage. Okay. As an agent, you're a person. A person under the eyes of the California Insurance Code is any legal entity. Person, association, organization, partnership, business trust, corporation, limited liability company. Any one of those is a person under the eyes of the California Insurance Code. Okay. You might get the definition of what is a natural person, and a natural person is an individual human being, just like you or I. All right. So a natural person is a person, but a person is not necessarily a natural person because a person could be a corporation. All right. So you got to be wary of that. An insurance agent, you represent the company. Your job is to sell insurance to the public, okay, or the client. So again, you're contracted by the company to sell their products. When you sell their products, they pay you a commission. Now, a broker represents a client to an insurance company. So they represent the client and they place business with, but not on behalf of an insurance company. Brokers get paid by charging the client a fee. And so in this slide, you basically represent whoever pays you As an agent, the company pays you a commission, so you represent the company. Your job is to sell insurance to the public. But as a broker, you charge a client a fee. And so you're going to represent the client in finding the best coverage at the best price on behalf of the client and place them with that company that has that best product at the best pricing. Brokers have to post a $10,000 bond to protect clients' money that they're collecting, like the fee. Okay, so be wary of that. And neither one of these can offer life and or disability insurance. Okay, these are the property and casualty broker agents. All right. An insurance agent, which we just discussed, and I'm comparing it with a life agent. So insurance agents and life agents, in both cases, you represent an insurance company. Your job is to sell insurance to the public. An insurance agent does the property and casualty world, or all types of insurance except life and disability. A life agent sells life and or disability. Okay, you got to know the difference. In the real world, if I roam around aimlessly and people say, hey, what do you do for a living? And I say, I sell life insurance. In the real world, they say, oh, so you're an insurance agent. And in the real world, call me whatever you want. Just buy my policy. I'm good to go. But in the test world, that would actually be inaccurate because I sell life insurance. Therefore, I'm a life agent. Now, if I say I represent multiple life insurance companies, in the real world, people say, oh, so you're a broker. And in the real world, again, you can call me anything you want. Just buy my policy and I'm happy. But in the test world, that would be inaccurate. Because in the test world, there are no brokers in life insurance. You're an independent life insurance agent. That means you're licensed and contracted to place business with multiple insurance companies. But when you sell the insurance, you're only paid commission. You can't charge a fee in the life insurance world. Okay, not to sell life insurance. On the property and casualty world, if you're a broker, you can charge a fee, but agents cannot charge a fee. Okay. So the California Insurance Code cites a specific definition for a life agent. A life agent is, they're all going to be false, okay, because none of them say you're selling life and or disability insurance, okay? So be aware of that. All right. So other items I added here, life and disability analyst versus a third-party administrator. You got to know the difference between these two. A life and disability analyst, this is a fee-based consultant. So it's on the life and health side, but unlike an agent, they don't sell insurance. They're just a fee-based consultant. They're going to review your income, your investments, your expenses. They're going to say, this is how much insurance you should have. This is what kind you should have. And they're going to charge you a fee based on that, right? Based on a written agreement. And they have to pass another exam. Now, third-party administrator, this is a different person. It's still a life agent license, but your job is you have an independent firm. Your job is to collect premiums and pay claims on behalf of an employer in dealing with life insurance, health insurance, and annuities. So you're working with group companies or group programs. This is where you have an employer, a company owner, paying you a fee to run their benefits program for them. In order to be an administrator, the bottom paragraph there, you must have what's called a certificate of registration to act as an administrator. Okay. So that certificate of registration is with an insurance company, not with the Department of Insurance. All right. So of the items listed below, which are requirements for a life and disability insurance analyst license? And it's going to be all of them. So you've got to have a good reputation, either professional and personal. You got to be at least 18 years of age, and you got to be knowledgeable. That means you have to pass another exam also. Okay. So which of the following is correct about a third-party administrator? And again, they're an independent firm, and they provide administrative services for companies' self-funded programs. Self-funding is, let's say we have a large company, lots of employees, and we just don't want to spend money on health insurance because it's too expensive. And so what we're going to do is we're going to set up an account. We're going to put money in this account. And if our employees suffer medical bills, we just pay their claims out of our company's assets. That's truly self-funding. You don't buy health insurance, okay? But if a couple of your employees suffer some, incredible losses, a couple $1 million, you might even go bankrupt. And so rather than go bankrupt, let's set a limit called a stop-loss limit as part of what was called a stop-loss contract. To where as an employer, you're not going to buy health insurance, but you will set up, actually, you are going to buy health insurance. Sorry, you're going to buy a health insurance policy with a company that has an extremely high deductible, like $2 million. So So as an employer, you're setting up a health insurance policy with a $2 million deductible. And so you're covering all your employees' medical bills until you pay $2 million in claims. Once you pay $2 million in claims, then the insurance kicks in and covers the rest. So that keeps your company from going bankrupt. Okay. But on a group program with a $2 million deductible, when you raise your deductible, that's going to lower your premium. All right. So that's how that works. To help administer this program, you might contract a third-party administrator, sometimes called an ASO, Administrative Services Only contract. Okay. According to state law, what size print must be used for the licensee's license number on all price quotes, business cards, and printed material? And it's got to be the same size. As much as you want to pick, well, as long as it's larger, then that's great. No. The California Insurance Code states your license number must be the same size as your phone number on your advertisements. Anything used to market or solicit insurance must have your name and your license number on it. Okay. So Ben is a life agent. He'd like to do business with the Rock Solid Insurance Company, but he doesn't have an appointment to sell their policies. Assuming Rock Solid does not require exclusive representation, can Ben submit an application to them from a prospect? And yeah. So here's the thing. Ben is already a life agent, so he has a license. He's just not appointed by this other insurance company. And so if he submits an application and they accept it and issue the policy, they now have to appoint Ben as an agent within 14 days. Okay. A lot of you probably will not go this route, but it is doable when you're representing independent firms, and you can, as an independent agent, you can represent multiple companies. I should say independent life agent. So this is one way with those independent companies. They want business, and so you submit an application to them. Don't take premium, because if you take premium on a policy that you are not an agent for, and you accidentally bind coverage. If you bind coverage for a company you're not an agent for, it's automatic license suspension. So Ben, who's licensed, if he places this application with that insurance company, he shouldn't take premium. Have him submit the application, get it approved. When they issue the policy, then they have to appoint him as an agent, so he can now sell their policies. Okay. Assuming continuing education requirements have been met, how is your license renewed? Well, 90 days before your renewal date, the Department of Insurance will send you a notice saying this is a continuing education you need to complete, and these are renewal fees you need to pay. Your license is good for 2 years. So even if you completed everything on the last day of the month of the 2-year cycle, because even though you pass your test in the middle of the month, your license renews at the end of your renewal month. So just so you know. So you have till the end of the month. Now, so let's say you completed everything on the final day and you submit it to the Department of Insurance. As long as everything's in on time, you can still sell insurance for up to 60 days while waiting for the new license to be issued. Okay, so that's going to be a different question. All right, someone completes his renewal process, but he hasn't received his new license as yet. Which of the following is a correct statement? He can transact insurance for 60 days while waiting for the new license to be issued, as long as everything's in on time. If he's late, well, your license is good for 2 years. After 2 years, you still got 1 more year to renew it, but there's a 50% penalty on the renewal fee because you're late. If you don't renew your license by the end of that 3rd year, you start from scratch. You're going to have to go online, do the 52 hours all over again, and study and take this test all over again. Okay, so don't let it lapse. All right, do the continuing education, pay the renewal fees. Okay. If you need help with that, give me a holler. All right, this particular page, we got quite a few questions, probably 8 or 9 questions just on this particular screen slide. All right, so first of all, we'll start with the top of the middle. The entire contract consists of the following: the policy and when attached the application. That's a test question. The entire contract provision consists of which of the following? The answer is the policy and when attached the application. Let's start with the application. Application has 3 parts: general information, like name, address, and things like that. Medical information is where you're asking questions about their past medical history, like when have they been to the doctor and hospital, and why, okay? And there's also the agent's report, which the client never really sees, all right? This is you talking to the insurance company underwriter about the prospect. It's going to ask you questions like, how long have you known the proposed insured? Do you know if they drink? Do you know if they smoke? Do they participate in high-risk hobbies? Are we insuring the children? Do they look healthy? Is this a replacement issue? Is there anything else we, the underwriter, need to know in determining whether or not to issue a policy for the proposed insured? And so in sitting with a client, if you see something that doesn't quite match up to what they're saying, like, you ask them if they participate in any high-risk hobbies, and they say no, but yet right behind them are some pictures on the wall of them skydiving, and you're looking at the date stamp on the bottom right-hand corner, and it's like 2 months ago. Then if you don't want to broach the client with the topic, which I do, you can put on your agent's report and let underwriting deal with it. A lot of times they'll do a telephone interview. They'll call your client and ask some additional questions regarding the risk. Okay, but for me, if you're going to be my client, you got to be upfront with me, because I'm definitely going to be upfront with you. So I present it. Now, right below that, I have a non-medical application. Very common test question. A non-medical application is for small face amount policies, where you're going to ask the client maybe 3 to 5 questions. As long as they say no to all those questions, and then your underwriter does a quick check, then there's no other underwriting needing to take place. But it's tricky for the test, because a non-medical application doesn't mean we don't do a medical. A non-medical application means we may still need to do a medical. So if they answered yes to one of those, 3 to 5 questions, or they said no in our quick check, it kind of turns up something, then again, it may lead to further underwriting and additional information. So watch out for the test question. A non-medical application doesn't mean we don't do a medical. It means we may do a medical. Okay, so that's one part of the contract. The other part is on the left-hand side, the policy. The policy has 4 parts: title page, insuring clause, conditions clause, and exclusions. You can look at it TICE. Okay, the title page is sometimes referred to as the policy face. It's the first page of the policy. It tells you who the insurance company is, right? It tells you who the insured is. In the middle of that front sheet, there's 2 bold lines, and in between those 2 big bold lines, it says, please read this contract carefully, which most people don't. And at the bottom of that title page, there's a paragraph that describes the type or kind of policy you bought. And that's going to be number 2. That's what we call the insuring clause, because the insuring clause tells you the type or kind of policy you bought. So an example would be that you bought a non-participating whole life policy to age 121, and that's basically it. So it just tells you the type or kind of policy you bought. The conditions clause number 3 tells you the duties and rights for you to collect on the policy. A lot of times the exam will say it spells out the obligations of each party. The client is obligated to fill out the application, pay the premium. The company is obligated to investigate, settle, and pay any claims that come in. And so it just spells out the duties and rights of both parties. But more specifically, you might get a question that says it spells out what the insured has to do to collect for a claim. All right. Number 4 is exclusions. It's real simple. What's not covered? Suicide in the first 2 years for your life insurance policies. Sometimes there'll be war or military exclusions, along with aviation risks that may be excluded from coverage. All right. So the policy and when attached the application together make up the entire contract. Make sure you understand that. Now, in the top right-hand corner, a representation is defined as the best knowledge and belief of the party offering information. So when you're sitting with a prospect, you're going to ask them questions on the application, and they're going to answer you with representations. To their best knowledge and belief, they don't know of anyone in their immediate family that's had heart disease, liver disease, cancer, diabetes, etc. So when they tell you no, to their best knowledge and belief, no, you're going to trust that, and you're going to put that on the application. If you don't trust them, then you shouldn't be sitting with them writing a policy. Okay? So they're going to tell you verbally, and then you put it in writing in the application. So a representation may be oral or in writing, but it is defined as the best knowledge and belief of the party offering the information. Your clients can change their representation before the insurance goes into effect, but not afterwards. Okay? So I ask a client, hey, do you participate in high-risk hobbies? They tell me no. I put no on the application. That night I go home, right? And they call me. They say, hey, that high-risk hobby thing? we go hang gliding every 6 months. I mean, we've been doing it for years. We find these exotic locations, and I don't know. To us, it's not a big deal, but is that high risk? Yeah. You're strapped to a kite, so yeah. So I changed the representation. I changed what they wrote on the app. I go back to them. I have to have them initial the change. So you, the agent, can change what client wrote on the policy or on the application, I should say. Have the client's initial a change. Clients can change what they wrote on the app. They initial the change. And an officer of the insurance company, like an underwriter, can actually write on the application, but it doesn't affect the coverage. So those are the three people that can write on the application. Okay. All right. So now on the left-hand side, top left, we have a warranty. And a warranty is defined as a statement of fact that must be the exact truth. And like I said, warranties are either express, which means in writing, and implied, which means not in writing. Okay, so it's expressed in a life insurance policy that if you die, we will pay the named beneficiaries the face amount of the contract. That's in writing, that's express. Okay, implied is part of the contract, but not in writing. So like I said, express means if you die, we pay our beneficiary the face amount. The implied part, which is not in a life insurance contract at all, is how you died. So if you died on a north-facing street on a Wednesday with a red trench coat on, with 1 foot in the gutter, with the sun in your eyes, and you pass away, the policy doesn't say you have to die that way. It's just assumed under contract. Okay? And so express means in writing, implied means not in writing, but still part of the contract. Okay? You can say assumed under the contract. All right? So warranties carry the most weight in insurance. It's defined as a statement of fact that must be the exact truth, whereas a representation is the best knowledge and belief. Okay, so fact versus the best knowledge and belief. Okay, so you got to know the difference. Okay, a representation may sometimes be an implied warranty, but a representation can never be express. All right. All right, now at the bottom of this chart, transacting insurance, there's 4 parts of transacting: solicitation, negotiation, execution, and transaction of matters subsequent to execution of a contract and arising out of it. So solicitation is your advertising, marketing, trying to get the client to meet with you. That's part of transacting because you're trying to solicit. Negotiation is you actually reach them and you start conversing, or they may say, hey, can you email me some more information? That's part of negotiating, trying to get them to buy. The execution is they actually buy the contract. You submit the application, goes to underwriting, it's issued, and then you deliver it. And in transaction of matters subsequent to execution means the policy's on the books and now you're servicing it, maybe adding a child, they bought a new car, whatever it may be. You cannot do any one of those unless you have a license. If you transact without a license, it's a misdemeanor. It's a $10,000 fine. All right, that means don't do it. Okay, but that's what transacting insurance is about. The bottom right-hand corner, parts of a contract. Now this is contract law we're talking about here. All right. So we have consideration, and under contract law, consideration means there's an exchange of value. Clients give 2 things of value. They're going to pay premium, and money's valuable, and they're going to provide personal information about themselves. That's valuable also. All right? So it's the act of filling out the application, paying the premium, and then the company has to give something of value back, and the insurance company gives a promise. So it's an act of filling out the application, paying the premium for the promise of receiving benefits if a loss occurs. That's what consideration is in insurance. Legal purpose means you bought insurance to protect against a loss. Now, in all your studies, that's what you're going to learn, protect against a loss. Insurance is there to protect against a loss. And then you go take the test. Legal purpose means you cannot get a gain. That's just another way of saying to protect against a loss means you cannot get a gain. We're just covering the loss. You see, so again, that's what makes this test a bit tricky, is because you're taught one way, and then the test hits that topic from the other side, and you don't even recognize it. So you got to watch out. Another thing your test does is they go a little crazy with a thesaurus. So instead of saying legal purpose, it might say legal objectives. Okay, so be wary of that. Likewise, up on parts of a policy where it says insuring clause or conditions clause, okay, they might change that, insuring agreement or the conditions agreement. Okay, so be wary of that. Your test goes a little crazy with the thesaurus. Okay, so that was legal purpose or legal objectives. Agreement is broken down into offer and acceptance. So in insurance, it's typically the insurance company that's making the offer through you, the agent, because you, the agent, have to convince the client, hey, you should get a life insurance policy. Okay, so that's the offer. We're offering to sell you a policy, and the client has to agree to that offer. You're right, I do need a policy. And so they're going to fill out the application and pay the premium, and they're going to give that back to you, the agent, who present it back to the company. This is actually a counteroffer. Here's the information you requested. Can you insure me at what you put in your illustration? The company accepts this counteroffer and they underwrite it and they say, well, we can insure this person, but because they have a medical history in their background, we're going to have to charge them higher premium. Ask them if they still want it. So here could be another counteroffer to the client. Yes, we can insure you, but you have to pay higher premium. Do you still want it? And the client may say, well, yeah, I knew that was going to catch up to me, but I should get the coverage to look out for my family. So it doesn't matter who makes the offer. Both parties have to agree to the conditions in the contract for there to be agreement. Okay. The fourth item here is you got to deal with competent parties, and that's people in their right mind. So if you're dealing with someone that they just don't seem all there, bow out gracefully. As much as you want to write anybody and everybody, some people just follow your intuition, just bow out gracefully. Okay. So, yeah, people that are not mentally competent, someone who's under the influence of alcohol or drugs, their judgment impaired. You cannot sell them an insurance policy. Okay. A minor cannot legally enter into a contract. Okay. And so these are some things that you're going to define what a competent party is, that can or cannot enter into a contract. So be wary of that. Okay. So there's quite a bit on this page. We probably covered about 8 or 9 questions at least just on this one page. Okay. Employees that have group life or health policies covering them are required to be issued a certificate. So when you get hired by a company in that new hire packet, you got a certificate of insurance. You know, it's that thing you didn't probably read, like most people, because you were just happy to have a job, right? So, but the employer that set up the program, that's the next question. Employers that have group life or health policies for their employees are required to be issued and they are the master policy or master contract holder. So your employer is buying a program or setting up a program for the benefit of the employees. So the employer sponsoring company is the master policy holder, and the employees show that they're part of their group program by getting a certificate. So group life insurance is usually just one page front and back. Group health insurance is probably a book because it needs to explain the benefits involved with that contract. Okay. So, I mean, honestly, just changing one word from employee to employer basically changes this question. So it's easy to fail this exam and not realize how you failed it because you didn't realize you studied one way and they change a word and you didn't realize it. So you got to be wary of that. Okay. OASDI is the original name for Social Security, and believe it or not, it was called Old Age Survivors and Disability Insurance. So the government is an insurer. They provide insurance. They're not an insurance company, but they are an insurer. And one of the insurance programs they offer is Social Security. This thing's bouncing here. Apologize for that. And the first type of benefit is retirement. So in order to receive retirement benefits, full retirement benefits, you have to achieve what's called fully insured status, and that's paying in for 40 calendar quarters. And so if you paid basically into Social Security for 10 years, you qualify for benefits under Social Security for retirement income. And you can take early retirement at age 62, but you only get 80% of what you're entitled to for the rest of your life. Right? You'd have to postpone retirement to age 65 or 67, and that depends on when you were born, in order to receive 100% or full retirement benefits. Okay, so it's based on paying into the system. You probably saw credits in your online study, but on the test, they'll call it quarters. So every year you have 4 quarters. So it's, if you paid in 1 year, you get 4 quarters or 4 credits. Okay, so just so you know, so 40 quarters, that's 10 years. Okay. So, and it's all based on it's also based on how much you paid in also. Okay. Another benefit is survivor's benefits. There's 2 benefits, possibly. Number one, $255 in a lump sum to cover burial. That's what it was back in 1937 when they put this into place, and they have not changed it since, because in order to raise that amount, we have to charge higher Social Security taxes, and the voters have said we don't want to pay more taxes. And so that will never change. But if you have a surviving spouse with minor children, they can also receive income. And so the survivor's spouse can receive income until the youngest child turns age 16. So if you have an 8-year-old child, your spouse is 30 years old, and the covered worker dies, the surviving spouse will receive the income for 8 years. Remember, their child's 8. After 8 years, their youngest child turns 16. The survivor's income benefits end to your surviving spouse. They don't get anything until actually age 60. As a widower, they can take early retirement. Okay, so that period of time between when the youngest child turns 16, but before the surviving spouse turns 60, that's called the blackout period. And that's when there are no Social Security income benefits, survivor's income benefits are paid. Okay, so always remember, it's when the youngest child turns 16, the income stops until the surviving spouse turns 60, and they take early retirement. That's the blackout period. Disability benefits are another thing provided by Social Security. If you do qualify by meeting this definition, we're going to discuss it. You still got to wait 5 months before they give you the first check. So Social Security disability income benefits have a 5-month waiting period. The other way of saying that is benefits for Social Security disability begin on the 6th full month of total disability, which still means there's a 5-month wait. Okay, so again, I don't know which way the question is going to be asked, but it's very common to get a question on that. So there's a 5-month waiting period, but another way of saying that is benefits begin on the 6th full month of total disability. Okay. The definition of Social Security total disability is these next 2 bullets. You cannot perform any substantial gainful work activity due to physical or mental impairment. That disability must last at least 12 months or is expected to end in death. That means if you are a $200,000 a year neurosurgeon where you get a pinched nerve, you get the shakes and cannot perform neurosurgery anymore, if you can still work at McDonald's making French fries, you wouldn't qualify because you can still perform sub-job function in the national economy and be paid. So this is the most restrictive definition of a disability you'll probably ever find. So just to give you a heads up, Social Security total disability benefits are the most restrictive definition you will see. Okay, so there's 3 of the 4 benefits. The 4th benefit is Medicare. Now, Medicare came out in 1965. It originally provided 2 parts, Part A and Part B. Part A, as you can see, covers a hospital. Think of that covers the room and board, and you've earned it by paying into Social Security. If you do use Part A, there's a deductible. I'm not going to put dollar amounts here because it's not on your test, but just know that Part A has a deductible that you got to pay. And then when you're in the hospital in a semi-private room, there may be some copays. So Part A gives you 90 days inpatient care. That means 90 days in a semi-private room. The first 30 days are free. I'm sorry, the first 60 days are free, sorry. The 61st through 90th day, you have a daily copay. Okay. Now, when you use up those 90 days, if you're still in the hospital, then you can start dipping into your 60 lifetime reserve days. So these are additional days that you can access if need be. But they're going to cost you double your daily copay for the 61st through 90th day. Let me explain. As a senior citizen, you go into the hospital, okay, because you need some hospital stay for whatever happened. You got an ailment, illness. You got to pay a deductible. When you pay the deductible, the first 60 days, Medicare is going to cover your time in the hospital in the semi-private room, just the bed. The 61st through 90th day, you've got roughly, it changes every year. I'm going to throw out something out there. It's about $250 a day. That's your daily copay. So for the 61st through 90th day. After the 90th day, if you're still in there, then you can dip into those 60 lifetime reserve days. But those are going to cost you double that $250 copay. So those are going to cost you $500 a day to use. Okay. I got to be honest with you, $500 a day is less than the $4,000 semi-private room rate. So you go broke a little bit slower. So after 150 days, if you're still in that hospital, because you haven't got released because you still need to be there, well, now you're paying the full semi-private room cost, which is about $4,000 a day. Should you get out of the hospital for 60 consecutive days, and on the, let's say the 68th day you go back in, well, that's a whole new benefit period. All right. So anytime you come out of the hospital under Medicare Part A for 60 days, then you start a whole new benefit period. So let's say you go back in on the 68th day. Well, guess what? You got another deductible again. The first 0 through 60 days, Medicare is going to cover. The 61st through 90th day, you get that daily copay. If you're still in there past that 60 days, now you're paying all out of pocket. That's right, out of the 90 days. Sorry, the 90 days. So the 90 days of inpatient stay get replenished, but the 60 lifetime reserve days, once you use them, that's all you get from age 65 till you die. And if you used them on your first visit, in our example, then you can't tap in anymore. You used them up. Now, when you get out of the hospital, if you can't do things on your own, you might have to go to a skilled nursing facility. Make sure you make a note. It's very common to be on the test that Medicare Part A provides 100 days in a skilled nursing facility. You typically have to be hospitalized for 3 days in order to dip into this. And there's also got to be an expectation of getting better in order for you to use these 100 days. Okay. So let's say we get out of that skilled nursing facility, we're able to go home, and we need occasional visits from a home health aide. Home visits are covered. There's no limit to the number of covered visits from a home health aide. Okay. But if we're terminally ill, then we might need hospice, and Medicare Part A provides hospice. So I want to make sure you understand that Part A covers the room and board. So think of this covers the bed. All right. Now, Part B is the medical side. This covers the doctor and the surgery. And so Part B, you sign up and pay a premium for it. Now, there's an annual enrollment period or an open enrollment period. You might just see AEP or OEP on the test, and it's usually the first quarter of every year. So when you sign up for Part A, the first quarter, you sign up for Part B. You pay premium. It comes out of your Social Security retirement income. There's deductibles for Part B, and now we have coinsurance. Now, it's an 80-20 coinsurance of allowable charges, not on anything, just an allowable charge. All right. So the client, or you, the customer, you're going to pay 20% of the claim after you pay the deductible. Medicare pays 80%. You need to know that. Very common to get questions on that. Okay, that's of the allowable charge. All right. Now, let's say when for Part B, you're going to submit claim forms, and let's say Medicare Part B says it's not covered, and you think it should be covered. Well, there's an appeal process you can go through, but keep in mind that only Part B of Medicare may be appealed. You can't appeal Part A. Part A right here. These are your it's set in stone. 90 days of being in a semi-private room, you exhaust that, you dip into 60 lifetime reserve days, 100 days in a skilled nursing facility, and home visits and hospice. Hospice has a limited number of days also, okay? And so this is cut and dry what your benefits are over here. But Part B, there's a lot of room for negotiation. 80-20 of the allowable charge, well, what's allowable? And so you can actually appeal Part B. You cannot appeal Part A, okay? So there's more to this story. You sign up for Part A because you've earned it. You pay premium for Part B when you sign up for that. But if you don't like this, then trade it in for Part C. Now, Part C is where we have private insurance companies partnering with Medicare. And so they're basically going to take an allotment from Medicare and basically with additional premium from you, by the way, and it's called Medicare Advantage, but they're going to give you more of an HMO, PPO type of program. Okay. So I don't know about you, but I mean, deductibles, coinsurance versus I pay additional premium and I get HMO, PPO coverage. You know, in HMOs, you just have a copay for covered services. So even though it's additional premium, may be worth it if you're used to it now. What competes with Medicare Part C is Medicare supplements. There's 14 plans, plans A through N. As an insurance company, you do not have to offer all 14 plans, but you do have to offer Plan A, which is the core benefit plan. The core benefits are the minimum benefits that must be offered in order to call it a Medicare supplement policy. When you first enroll in Part B, you have an open enrollment period of 6 months to buy a Medicare supplement policy without a medical exam. Okay, that's called the open enrollment for Medicare supplements. All right. And then Medicare Part D actually goes back to the federal program. That's for prescription drugs. Okay. And so there's your Medicare program. Right. So let's cover some of the questions on this. In the life insurance planning process, the blackout period is considered. And like I said, that's the time where the surviving spouse does not receive Social Security benefits. Okay, very common test question, folks. Remember, it begins when the youngest child turns 16 and ends when your surviving spouse turns age 60. Okay. All right. All right. So now let's go into life insurance. There are 4 classes of life insurance. The first one is industrial life. It still makes up about 1% of insurance in force, but it's kind of known as a debit plan. Industrial life policies is where the agent wore a suit during Industrial Revolution. They'd roam around the neighborhood with a rate book and collect premium directly from you, usually weekly, sometimes monthly, collected in person. So they'd knock on your door, collect premium from you. Whatever you could afford, whether it's a quarter to $1 that week, would determine the face amount should you or one of your family members die that week. Most people only bought $1,000 to $2,000 face amount. The maximum face amount of an industrial life policy is going to be $10,000. So it's basically just a burial policy that came out during the Industrial Revolution and is still in existence today, just not as rampant. Okay. We're going to talk about ordinary or individual. Whenever you see ordinary life insurance, it's synonymous with it's an individual life insurance plan. And that's different than group insurance because that covers a group. And it's different than credit. Now, we have 2 types of credit insurance. We have credit life and credit disability. So credit life, if you die, we pay off your debt. Credit disability, if you suffer a disability, will make the minimum monthly payment to your creditors while you are disabled. All right. Once you recover from the disability, then you just take over and pick up where we left off. You don't have to make up those missing payments. Okay. And so these are the 4 classes of life insurance. So all of the following are reasons for an individual to purchase personal life insurance, except, and that's covering a buy-sell agreement. So buy-sell is more of a business use. The question is asking which is a personal use. Okay, so keep that separate. Key person life insurance also is a type of business program. And so the question here would be, why would a business use a key person life insurance policy? And it's to protect the company from one of their executives dies. So huge corporations, they're insure their executives or officers, like your CFO, your CEO. If your CFO passes away, number one, your business is going to take a financial hit. So you're going to need money to replace the income that they would have normally brought, okay? But you're also going to need money to hire and train a replacement of their caliber. And that's what key person life insurance is all about, is providing this corporation with money to hire and train a replacement and replace lost income because of their executive passed away. Okay. Now, key person life insurance is just like personal life insurance. Is the premiums are not tax deductible because the corporation benefits from the insurance. It's more of a capital investment. It's not a business expense. Now, if a company buys insurance, like let's say we have a company, we have a group life insurance program that we're going to give to our employees. That means your employees can name anyone in the world as a beneficiary except our company. Because we can't give you free insurance just so you name us as a beneficiary. We make money off of you, okay? But since that program benefits the employee and their family, that premium is going to be tax deductible to the business. So that's a business expense. But key person life insurance, since it's designed to perpetuate the continuation of the company, it's a capital investment and therefore not tax deductible. Okay. Identify the statement that is true about contributory group life. Whenever you see the word contributory, means the employees actually have to contribute some or all of the premium. So your employer is setting up a group insurance program, but the employees have to pay some or all the premium. So maybe the employer will split the group insurance premium with the employee. We'll go 50-50. Okay. So for you, the employee, it would be cheaper than buying an individual policy because, well, your employer is paying half of the premium, which is kind of nice. But also with a group program, even if you, the employee, paid the full premium, it's cheaper than an individual policy because with a group program, there's purchasing power because numbers in the group. The larger the company, the more buying power they have and the cheaper the rates are for the insurance. And so it may be advantageous to get on a group sponsored program rather than buying your own individual policy. Okay. All right. Another somewhat tricky question. Jamie, an office manager, fell off a horse while visiting her mother on vacation. So when you see Jamie, an office manager, you're kind of thinking workers' compensation. But it says she fell off a horse while visiting her mother on vacation. So now you got to make a mental note that this is not work related because she's on vacation. So it rendered her completely paralyzed. After a year, the doctors feel she will not recover from her injuries. Choose from the selections below the program from which Jamie will be able to collect disability income benefits. And since it's not Social Security, since it's not workers' comp because she fell off a horse while on vacation, it's Social Security. Now, A, Medi-Cal, and B, Medicare, those are health insurance. They don't provide income at all. So your answer is kind of between C and D, but since you fell off a horse on vacation, that eliminates C and you're left with D. Social Security can provide income if she's totally disabled. Okay. It may not be falling off a horse. It could be falling down a flight of steps while on vacation. So find out where the injury occurred, because that'll help differentiate whether it's work-related and workers' comp or not work-related, which would be Social Security. Okay. Which of the following supports the Medical Information Bureau, or the MIB, and its insurance companies? 99% of your life companies, 85 to 90% of your health insurance companies actually financially support the Medical Information Bureau, or MIB. It's a nonprofit clearinghouse for medical information for insurance companies to basically look at your past medical history. Okay, everything's in code form, so don't think anyone can just access it. Okay, if your insurance company's paid into it, they get the code, they can access your background. Now, a couple of things you need to know about this for the test. Number one, it keeps a 3-year history for you. Okay, for the test, it keeps a 3-year history. Number two, you cannot be declined for insurance based on information on the MIB. So on the MIB, anytime you purchased insurance, got issued a substandard policy, anytime you got rejected when you're buying insurance, or anytime you filed a claim with an insurance company, it basically is going to go on this MIB. And so now you're buying a life insurance policy. The underwriter is going to look up the MIB and it says you saw a doctor on this day. Well, as an underwriter, I cannot decline you for insurance because you saw a doctor on this day. However, I better go talk to that doctor. I got to go talk to that doctor, find out why you went into the hospital on that day. If that's serious enough, then I can reject you. Okay, so it just tells the underwriter where to look. Okay, so a lot of times when the underwriter's going to look at the MIB, and realize you went to a doctor, they're going to contact the doctor and get what's called an attending physician statement. And so if you went to a doctor on this day, you told us you went in for a checkup, but we get the doctor's side and they find out, well, they did some tests and you found out you're terminally ill of cancer. We can reject you for coverage based on that. Okay, so again, it just tells the underwriter where to look. All right. And it's a rare question, but if you want, you can actually get a copy of your own MIB. I think it costs like $7 or $9. So you can get your own copy of your MIB to see what it says on there. All right. There are 4 basic classes of life insurance. All of the selections listed below are regarded as ordinary insurance, except group life. So remember, ordinary means individual. Group means group. Right? That's how you want to know that. So there's some key words in the questions as you go through it. And I want to point out here and there, like this one, ordinary insurance, that's an individual policy. Okay. So, yeah, a lot of people, I don't know, this is a tough one. So if you don't understand that, these are all insurance. So, all right, a lot of people don't make that relationship. All right, let's go on. So let's talk about individual life policies. The first one we're going to talk about is simplest, and it's term insurance. Term insurance is pure death protection for a limited number of years only. That term can be 1 year, 5 years, 20 years, 30 years, or anywhere in between. We've had companies set up a 7-year term, a 15-year term. It only covers you if something happens, you die during that term. If you outlive the term, you get nothing. So I equate this to renting. You're paying for coverage. If you outlive the coverage, you get nothing. It only pays if you die during the coverage period. Okay, it's like renting. You pay for a place to stay until the end of the month, and if unless you find someplace else, you got to pay another month's rent. So it only covers you during that period of time. There's no ownership as far as a cash value. All right, term has no cash value. It's pure death protection only. So if you're looking for cash savings, this is not it. All right. Term is inexpensive, so someone who has a high need for insurance and doesn't have a lot of money, term is probably going to be the answer because it's inexpensive. Again, I equate that to renting also. Renting is usually cheaper, but you get nothing from it. Okay, so it's a purest form of insurance. There's three types of term. We have level term, decreasing term, and increasing term. It's realistically just look at the face amount. Does the face amount remain level during the term? Does it decline in value during the term? Or does it increase in value during the term? Now, it doesn't matter what the face amount does. The premiums during that term are going to remain level. So even though you bought a decreasing term policy, which, the face amount is going to get lower and lower and lower as time goes on, your premium is still going to stay the same during that period of time. So a lot of people don't like that. My premium stays the same and I'm buying less and less and less coverage as I get older. Well, this is designed to cover an outstanding obligation, typically one like a home mortgage. So if you buy a house, as you pay off the house, you owe less and less and less and less. Well, that's what decreasing term is all about. It's just there to cover the outstanding balance of the mortgage in case you die while paying off that house. It pays off the balance. Okay. So mortgage protection, mortgage redemption, those are other ways of saying decreasing term insurance. On the bottom left, there's some other characteristics that we have on term insurance. We have convertible. So term is a temporary program. Well, if the contract says convertible, you can convert that temporary program to a permanent policy with the same insurance company. So you can convert your temporary term insurance to a permanent policy such as whole life insurance with that same company and with the same face amount. So if it's a $100,000 term policy, you can convert it to a $100,000 permanent policy like whole life with the same company. All right. So the face amount doesn't change, but your premium is going to go up. Because term is pure death protection, it's inexpensive. Converting to a permanent policy now is like owning. Owning costs more, but owning property now builds equity. Well, owning a policy, that policy is going to build cash value. So you can convert from temporary to permanent without a medical exam. You just have to pay higher premium, okay, along with filling out a form. Okay. Renewable. Well, let's say you have a 5-year renewable term. It means after 5 years, you can renew it for another 5 years. And after that 5-year period, you can renew it for another 5 years. So you're allowed to renew this temporary contract. No medical exam, which is awesome. Well, the catch is when you renew in 5 years, you're 5 years older. And so your rates are going to go up because of the increase in risk that you're 5 years older or 5 years closer to dying. And so renewable term allows you to renew without a medical exam with an increase in the premium. Okay. So now, even though it's renewable, in the early years it's great, but at older ages, well, you could price yourself right out of the market. Some companies only let you renew till about age 65 or 70. Okay. So you could be left without insurance at older ages when you might still need it. Okay. So from the descriptions below, identify which one is a term policy. And it's pretty simple. Just look for there is no cash value created. So each year the premium increases as you get older, but there's no cash value. Okay, that's term insurance. All the other ones have some cash value or something to do with cash value. Okay, all right. Now, whole life insurance gets a name from the fact that it covers you for the whole of life, which is to age 100 for the exam. In the real world, it covers you to age 121. We're using a 2001 Commissioner's Standard Ordinary Mortality Table, which uses a life expectancy of 121. The exam still typically uses age 100. And so you may get a test question, persons are considered to be statistically dead at what age? That'd be 100, okay? So whole life, we have a level death benefit, and within that level death benefit, you're going to be paying premium, and some of your premium goes to the cash value. In this case, it's going to grow at a fixed rate. And some of that premium will go towards the insurance, which is going to decline. But if you add your cash value and the net insurance together at any point in time during this contract, it's going to equal the face amount, which is a death benefit. So the cash value you can take loans and withdrawals from. All right. So let's say this is a $100,000 face amount, $100,000 death benefit. So this line right here represents the $100,000 death benefit. So if you died 10 years in the policy, That $100,000 death benefit is broken up by, let's say $10,000 in cash value. That means you're buying a net insurance of $90,000. So the $10,000 of cash value plus $90,000 in insurance, net insurance, equals $100,000 face amount or death benefit. Okay, as your cash value continues to grow, let's say we're kind of here at that halfway point. You have $50,000 in cash value. If you were to die here, your beneficiaries get that same $100,000 face amount, but that $100,000 is split between $50,000 in cash value and $50,000 of net insurance. So at any point in time during this contract, if you add these two parts together, it's going to equal the face amount or the death benefit. Now, if you live to age 100, your cash value will actually grow and equal the face amount. This is where we say the policy matures or endows. And the insurance drops and we cut you a check for the face amount of your policy. All right. So if you die before age 100, your beneficiaries get the face amount, in this case, $100,000. But if you live to age 100, the policy drops and we cut you a check for your cash value, which is the same $100,000, which is the same as your face amount. So whether you live or die, someone's going to get that death benefit, that $100,000. Yeah. So at age 100, you get the face amount. So no insurance. You don't need insurance anymore because now you have $100,000 in your pocket. You're what we call self-insured. Now, in general, with a whole life policy, you have continuous level premium. That means from day one of buying this policy till age 100 until you die, you got that level premium going. If you don't want to pay forever, you can do what's called a limited pay policy. Let's say you bought a 20-pay life policy. That means you pay premiums for 20 years. After 20 years, you can stop paying premiums. But with whole life, you still have coverage till age 100. So you're kind of buying life insurance the same way you buy a new car. All right, you want the 5-year loan or the 2-year loan. It doesn't matter which loan you get. It's the same car. And so life insurance also. All right, whether you want to pay continuous premium or pay all your premiums in 20 years, it's still a life insurance policy. So even though you stop paying premiums in 20 years, you still have that same coverage till age 100. Okay, it's more cost effective if you pay more up front and let it ride versus paying that level premium for the rest of your life. Okay. So a policy owner makes the last premium payment on his $250,000 non-par whole life policy today. The owner is 70 years of age. When will the cash value reach $250,000? Well, it's a whole life policy, so it matures when he turns 100. See, the fact that it's a non-participating whole life policy means nothing. It's a $250,000 whole life policy, and whole life matures at age 100. Now, you might see matures at age 100. You might say the policy endows at age 100. All right. Two ways of saying the same thing, folks. A family policy. Common to get a test question on this. As you can see, the base policy is a whole life policy, just like we had on the board. We're going to add the spouse on. Instead of having the wife buy a separate policy or the husband buy a separate policy, let's just add them on as a rider. It's a term insurance rider. And for the test, whenever you see rider, it's a temporary program added to a permanent policy. So riders are always term insurance for the exam. Okay, and so let's say they want to add the children on. We can add the children on as a child rider. Now, the child rider covers one child or 999 children. Just because they have another child, they don't have to pay additional premium. All children are automatically covered from birth until majority age. When that child breaks away from dependent status and they go off on their own, that child rider can break off and convert to an individual policy that they can continue to take over and pay premium and have continuous coverage later on. Okay, but the cool thing about a family policy is we're covering the whole family on one program. So one policy fee. Versus going in a household and there's husband and wife and 3 kids. That's 5 policies. So that'd be, one for the husband, one for the wife, and one for each of the kids. So 5 policies, 5 policy fees, 5 admin charges. That's not really cost effective for that family. So family policy, we cover them all on one program. Cost effective. Okay. A family income policy. This is a combination policy. We're taking a whole life policy, which covers you to age 100, and a decreasing term policy, let's just say for 20 years. So let's say we have a husband and wife, and they have a child, and we'll say one of them's a breadwinner, and we want to insure that breadwinner so that if they pass away, that child can still, the surviving spouse needs money to raise that child until they become majority age. And so we'll go with a whole life policy to age 100. We'll go with a decreasing term policy for 20 years. So like I said, if the breadwinner dies during this period, the child's 1, if the breadwinner dies 10 years in the program, well, then the surviving spouse needs income until the youngest child turns 21 and is up and on their own, okay? And so that's what this is for. So it's designed to pay an income if the breadwinner dies during the initial part of the policy, and it's going to pay for a set number of years until the end of this term policy. So maybe you have a surviving spouse and they're self-sufficient. They just need financial help while raising the children until the kids are grown. That's exactly what this is for. It's for the child rearing years. Okay. Now there's another combination policy called family maintenance. So instead of a decreasing term, we're going to use a level term. And so this one, if the breadwinner dies, let's say 10 years into this 20-year contract, I'm using this 20 years as an example, then the surviving spouse actually gets income for a set number of years beginning at the death of the insured. So instead of paying till the end of the term policy period, we pay for a specific number of years beginning at the death of the insured. So family maintenance has a greater potential payout, and yes, it's going to cost a little bit more than family income. You do need to know the difference that family income is whole life with decreasing term, and you need to know that family maintenance is a whole life with a level term rider. And both of these programs, family income and family maintenance, are only on the breadwinner. That's the individual that makes the most money in the household. That's how you need to know it for the test. Okay. So a family life insurance policy that provides coverage for children may be converted to permanent insurance for the children, but evidence of insurability is required. That's a false statement. All of the child riders, when the children break away from that dependent status, they can convert it to another policy, an individual policy, absolutely no medical exam. Okay. Now, I have a true-false question here. On my website, I do have a couple true-false questions also, but when you take your exam, there really isn't any true-false questions. They're all multiple choice. Okay, so get this concept down because that's how you need to know that for that test. So all my true-false questions, get the concept down. So when you see it, you're going to flip it to a multiple choice question, and you'll still be able to interpret that. Okay. Survivorship life or second to die policies. It's going to be all the above. Number 2, second to die policies. We don't pay when the first, let's say let me back up. We're insuring typically a married couple, and we don't pay anything when the first spouse dies. We pay the full face amount after a husband and wife both die. That's when we pay to a named beneficiary. So number 2 here, face amounts are usually $1 million or more because number 1, we need a high amount of money to cover estate taxes at the death of the second one. And since we're covering 2 people on one policy, number 3, the premiums are quite a bit cheaper. Okay, so this is more for estate preservation. These are for people that really don't need a death benefit if one spouse dies. See, the thing about married couples is it's community property. When one spouse dies, the surviving spouse inherits all the assets and unfortunately all the debt. Okay, and so you might see this topic a couple ways. This is one. Another way that I've seen it is we have a married couple and they have a special needs child. And the child doesn't need financial assistance if the first parent passes away, but they will need some financial help should both parents pass away. What would be the best program for the situation? And that would be the survivorship life policy because they need more money when the second person passes away. That's how that works. Okay. Frequently, juvenile life insurance policies contain a payor rider. This rider states that in the event of the payor premiums is disabled or dies, and the juvenile has yet to reach a specific age, the insurance company is going to pay the premium till that child reaches that specific age. Okay, so this is added to a child's policy, and it's actually designed to cover the parent policy owner. So if the parent policy owner dies or becomes disabled, we're going to waive the premiums on the child's policy till they turn age 21 or 25. And then the insurance company will give the option for that child to either continue the coverage or drop it at that time. Bless you. But we're going to preserve the policy during the child rearing years in case the parent policy owner dies or becomes disabled and can't afford it. Okay, so there's one way to preserve it. And the key point here is majority age is going to be 21 or 25. Don't pick age 18 on the test. That would be incorrect. Excuse me. Oops. All right. Universal life. whenever you see the word universal, you want to focus on flexible premium. So whole life had a fixed level premium. Universal life is a variation. Think of a whole life policy, but now it has a flexible premium. How's that? Another thing about the universal life policy is this cash value is going to grow at a current rate of interest with a guaranteed minimum called the contract rate. Whole life had a fixed level premium. Okay. So universal life policies actually were created in the 70s. Imagine if you had a savings account in the 70s with a bank. Your interest in your checking account was about 12, 13%. How's that? Today, a savings account at a bank is earning like 0.02% if you're lucky. Okay. So why would you buy whole life that had a cash value earning at about, 5% return? Why can you just buy term insurance because it's cheaper? And that difference in premium just put it into a savings account getting 12, 13%. And so a lot of whole life companies lost some money. So in the 70s, they created this universal life policy. So we have this unbundled approach to life insurance where you're going to buy insurance, which is going to take the form of a 1-year term. All right. And then we're going to throw in a cash value that's going to realize those current rates of interest. Now we know interest rates can go up. We also know interest rates can come down. So we'll give you a guaranteed minimum called the contract rate. So you're buying a whole life policy that has flexible premium, and now you get fluctuating interest rates in the cash value. So your interest rates can go up. You get the upswing in the cash value. If interest rates drop too low, there's a guaranteed minimum in case something happens. All right? So it's a variation. Another type of program is an indexed universal life policy. Okay. So an indexed universal life, just like universal life, it's another variation, but instead of using interest rates, we're going to basically mimic a stock market index like the Standard & Poor, and we give you the indexed return credited to your cash value. Now we know, so basically you get stock market play through an index account. So you get the upswing of the stock market through an index return with a guaranteed minimum in case that index kind of didn't do so well. Okay. So again, it's still flexible premium because whenever you see the word universal, think flexible premium. Right. So this is kind of really cool for a lot of people. They want the upswing of the stock market, but they want to protect themselves from the downside. And this is a program that can cater to that. Okay. Term is term. Sorry. Term is term. Universal is a term plus a cash value. It's an unbundled approach. So this cash value, and it just depends on how the cash value grows. Okay. So, all right. Cool. So when premiums are paid into a universal life insurance policy, insurers must make certain adjustments to the cash value. The company will add the current premium paid, and they're going to deduct the expenses and mortality, and then add current interest. So with a universal life policy, when you pay a premium, your premium goes directly into the cash value. The insurance company from the cash value, they're going to deduct mortality costs, which is cost of insurance, and expenses like overhead costs to keep the company around. And then they're going to credit excess interest on their investments that they've earned. And so when your money goes into this cash value, it's going to earn that guaranteed minimum interest rate, let's say 3%. Right? The company's going to deduct their mortality expense charges, and then they're going to credit any excess interest. So if the company's current rate of interest is 6%, your premium goes into cash value, it earns 3%. We take out our expenses and cost of insurance, and then the insurance company will credit 3% current interest. So the 3% contract rate that you're earning plus the 3% credit gives you that 6% return for that period of time. All right, so this is kind of that unbundled approach versus a whole life, which is all set in stone. Okay. One more variation of the universal life policy is now the variable universal life policy. So now we're taking that universal life policy, but now the cash value is going to grow at a market rate of the stock market. And so your clients actually choose the stocks, bonds, and or mutual funds that grow in the cash value of this particular program. So if they pick some really good investments, they could have substantial cash value to access later on. But if they choose some lousy investments, they could have little or no cash value. Okay. So in a variable contract, the cash value is not guaranteed. Now, look at the heading here. So whenever you see the word universal, it means flexible premium. Whenever you see the word variable, know that that's a securities contract. So that means it's regulated by the SEC, which is the Securities and Exchange Commission. Okay, so now we're investing into the stock market directly. So, and nobody can predict the stock market, so there's no guarantee. So in the previous examples, like index universal life, you have a guaranteed minimum. Universal life, you have a guaranteed minimum. Whole life is a fixed rate of return. But the variable universal life or variable life, there is no guarantee of cash value. Now, premiums can be scheduled or flexible. Okay. Usually when you see universal, think flexible. So if you see variable life, it's I doubt you'll get on the test, but that would be scheduled premium. Variable universal life, look for flexible premium. Okay. So variable life insurance policies and variable annuities are primarily regulated by or governed by, and that's going to be the Securities and Exchange Commission. So whenever you see the word variable, think securities. And remember, whenever you see the word universal, just think flexible premium. When an insured becomes totally and permanently disabled, her condition triggers a provision that keeps the policy in force even though they stop making premium payments. This is called a waiver premium provision. It's basically a rider. On this exam, you will get 4 questions on riders. This is the most common rider sold in the industry. In fact, I'd recommend it on everything I sell. So when you're selling a policy, you want to add this to it. So if your client becomes disabled, can't work, right, doesn't have an income, they just have to pay the premium for the first 6 months of being disabled. After 6 months, if they're still disabled, the insurance company waives the premiums on the policy. That means their life insurance policy stays in force, up and running, cash value continues to grow as if they're making premium payments, even though they're not. Okay, so again, that's what the waiver premium is all about. Oh, by the way, you pay the premium for the first 6 months. After 6 months, if you're still disabled, they waive the premium, and the insurance companies typically reimburse you the first 6 months premium also. Okay. Beth wants to buy more life insurance through her current policy. She calls you, the agent, and asks your opinion. You know Beth has a guaranteed insurability rider on the policy, so she can buy more insurance, and it's only at certain ages, dates, or anniversaries. So not D-dog at any time. It allows her to buy more coverage on certain ages, dates, or anniversaries. All right? So if you're 21 when you buy the policy, then age 24, 27, 30, 33, you can buy more coverage. So usually every 3 years. Life cycle events, marriage, birth of a child, college graduation, are other triggers that can allow you to buy more coverage if you have this rider. It's the only rider that allows you to buy more coverage without even qualifying. So this person buys a policy at age 21. They're diagnosed terminally ill at 22. They can still use this rider to buy more coverage because we don't care. Okay. The additional coverage is going to be charged at attained age. Not original age, attained age. So you're 21 when you first buy the policy, 24, we let you buy more coverage, but you're going to pay a 24-year-old's rates for that additional coverage. But the cool thing is there's no medical exam. Okay. Oscar owns a life insurance policy. He's been paying into it for quite a few years. He'd like to continue having life insurance, and he can afford to make the premium payments. He needs about 30% of the cash value for a couple of years. What would be the best course of action for Oscar? Take a loan. Take a loan and borrow from the contract. Okay. One of the things you need to understand about life insurance is find ways not to let your clients drop it. Because if your clients drop the policy to get another policy, they got to requalify, and they're also older, so the rates are going to go up. And so in this question, he can afford to make the premium. So why don't you just make the premium? Let's just borrow some of the cash value until you don't need it anymore, and you can choose to pay it back or not. Policy loans from cash values, there's no credit check. You don't have to give us a reason why you need the money, and you don't have to pay the money back. Now, if you borrowed from the contract and you don't pay it back and you pass away, the insurance company is going to pay your beneficiary the face amount minus what you borrowed, minus any interest you might still owe on that borrowed money, but the rest will still go income tax free to your beneficiary. Okay, so, all right. David has been named as an irrevocable beneficiary in a life insurance policy. David, therefore, has a vested interest in the proceeds that no one can change without his written permission. So usually in a court order, divorce decree, or estate planning situation, you'll name an irrevocable beneficiary. Whenever you see the word irrevocable, that beneficiary is set in stone. The only way to change that irrevocable beneficiary is if you have the irrevocable beneficiary's permission in writing to change it. That means if someone had a policy and named someone as an irrevocable beneficiary, they can't let the policy lapse. Because if they let it lapse, that'll actually jeopardize what the beneficiary is legally entitled to. And if they let the policy lapse and then pass away, the irrevocable beneficiary has a legitimate claim against the assets of that person. Okay, so yeah, so it's not commonly used, but for the test, very common to get a question on the irrevocable beneficiary. So you got to get the beneficiary's permission in writing to even take a loan. Because if you take a loan and don't pay it back and you pass away, that's going to reduce what the beneficiary is legally entitled to. They may not want you to do that. Okay, so that's how that works. If no other selection is made, which of the following settlement options becomes a default or automatic mode of settlement for the death benefit of a life insurance policy? That's lump sum. So for the test, and actually in the real world, lump sum is not an option. Lump sum is the default or automatic mode of settlement of paying the proceeds from a life insurance policy. And so let's say you have someone who has a life insurance policy, unless they choose a payout option, the proceeds are automatically paid in a lump sum. Let's say I have a beneficiary and they cannot save money to save their life. I don't want to leave them lump sum because in 2 months it's spent and they still got to go to work to put food on the table. And so what I might want to do is choose what's called a settlement option, which is like maybe fixed amount or fixed income for a fixed period of time. And I'm going to limit what they get so they don't blow it all in one, a huge party for the month. And so settlement options are limiting what the beneficiary gets. You're leaving them payments. And that's one way of looking out for people that cannot save money, is don't leave them lump sum, leave them payments. Okay. So, all right. Non-forfeiture options. This is a tricky part of the test. A lot of people don't understand this. Okay. You probably will get 2 questions just on this topic. So if you have a permanent policy that builds up cash value, then you will have non-forfeiture options. What that means is for some reason you've had this policy for a while and you're just kind of sick and tired of paying premiums where you just want to get rid of it. Okay, so I don't want to pay premiums anymore. Okay, great. So if I stop paying premiums and I have cash value, the non-forfeiture option says you do not forfeit your cash value. It's your money that's growing in the policy. So if you drop the policy, take the money, do something else with it. So on the bottom left-hand corner, one of the first things you can do is, let's say I'm a couple of years into this policy where this line is, right? I'm going to stop making premium payments. I don't want to pay for it. I can drop the policy, take my cash surrender value, and run. Run fast and run far, okay? No more insurance, but you have the cash value in the form of a check paid out to you that you can do whatever you want with, okay? There may be a tax issue here, because if you paid, let's say, $20,000 in cumulative premium, and when you drop the policy, there's actually $30,000 in the cash value. That's $10,000 more than what you paid in. When you drop your insurance, you drop your tax shelter. Your cash value in your permanent policy grows on a tax-deferred basis. You don't get a 1099 every year. So if you drop the policy and take the cash, and the money you take out of the policy is greater than the premium you paid in, that gain is going to be subject to ordinary income tax. So cash surrender means you may have a tax issue. And by the way, when you give up the policy and take the money and run, any gains are ordinary income tax. Do not pick capital gains tax on that test question. Let's say you don't want to do that. You don't want to pay taxes. So let's go on the top right-hand corner. Let's drop that policy, take the cash value, and apply it towards a term policy with the same face amount. This is called extended term. So you're taking the cash value from the first policy, dropping that first policy, and buying a term policy with the exact same face amount. Term has no cash value. Term is for a temporary period of time, which means if you outlive term, you get nothing. Okay, but maybe you needed to maintain that same face amount for a period of time for as long as your cash value paid for it. You just didn't want to pay anything out of pocket anymore. That's another option. All right. To be honest with you, if you don't pay the premiums and the company's been trying to contact you to pay the premium and you still don't pay it, the company will automatically institute the extended term option. So if you die without making premium payments, the beneficiaries still get the same face amount as your original policy. So if you don't want to do that because you plan on outliving that term contract, well, then let's drop that original policy, but this time we'll go to the bottom right-hand corner. We'll apply that money towards a reduced paid-up policy. So what we're going to do is we're going to drop the original policy, take the cash value, buy a smaller face amount policy. So we're going to reduce that face amount. But the cash value from that first policy, single premium, pays the premium on the reduced paid-up policy. So you have coverage for the rest of your life, smaller face amount than the first policy. You don't have to pay anything anymore because the cash value from that original policy covers it. So you choose a cash surrender value because you need money. You choose extended term because you need to maintain that same face amount. And you're going to choose a reduced paid up option because you want some coverage for the rest of your life. And all three of these options are because you do not want to pay premium on that original policy anymore. Okay. So know the difference. An example would be all of the following are true regarding a policy owner that ceases making premium payments on a 10-pay life policy and they select the extended term insurance option. So all the following are true about extended term except, and it will not have the same cash value because term has no cash value. Okay. That means if this is the incorrect answer, the other three are actually correct statements. That's another way when you're going through my questions. The answer is already highlighted. So if it's an incorrect answer, read the other answers because they're correct and it could help you answer another question. So we're going to leave the life insurance world and we're going to go to an annuity. Now, annuity is not life insurance. However, it is a contract with a life insurance company. An annuity is designed for retirement. It's a savings vehicle. You're setting up a savings account with an insurance company instead of a bank. So your money is going to grow on the left-hand side. It's going to grow on a tax-deferred basis. Interest compounds on interest until a later date like retirement, and then you're going to annuitize. That means you're going to stop paying in. You're going to start taking payments from this to supplement your retirement income. And when you're taking money out of the annuity, this is called the annuity period. So the accumulation period is the paying in period, and the annuity period is when you're taking money out. Now, a portion of every payment you take out is going to be part principal, part interest, and that interest will be taxable. And as you can see on this chart, under the annuity period, it is taxed based on an exclusion ratio. The exclusion ratio is down here, all right? How much you paid in divided by your expected return. Well, this is going to tell you what percentage of every payment is excluded from tax. That means the other portion is going to be taxable. So view annuities, keep it real simple. It's just a tax-deferred savings account with an insurance company instead of setting up a savings account with a bank. Setting up a savings account with a bank, you earn interest every year, but you got to pay taxes on it every year. So by saving with an annuity through an insurance company, you still earn interest every year, but it's tax-deferred. Interest compounds on interest. Okay. So when the public purchases annuities, they are attempting to address the risk of outliving their money. So life insurance protects against dying too soon. Annuities protect against living too long. Life insurance creates an immediate estate. When someone dies, there's a lump sum of money available right at the time that it's needed at the time of death. Annuities are designed to take a lump sum and liquidate it through periodic payments. Okay? Annuities are not designed to pay lump sum. All right? This is probably, I'd say, most common math question. If you even get a math question, this is probably it. Something this extreme. The name may change. Patrick has been diligent in investing money for his retirement. He's managed to put $100,000 of after-tax money into a tax-deferred annuity. Now he's ready to take the money out, and the insurance company that issued annuity says he will have a guaranteed payment of $8,000 a year for the rest of his life. This means he can expect a total of $200,000 back over his lifetime. How much of each year's annuity payment is going to be taxable? Well, he paid $100,000 in. Okay, so this is his principal called his cost basis. Now, cost basis is money that has already been taxed. All right, so he's going to put $100,000 in. Out of the $100,000, it's going to grow, and he's expecting to get $200,000 back. Now, out of this $200,000, $100,000 is just return of getting his money back. That $100,000 is going to be tax-free. That means the other $100,000 is subject to tax. So this is our exclusion ratio. Let me go back here. All right. Come on. All right. So exclusion ratio is how much you paid in, which is 100,000, divided by the expected return, which is 200,000. So 100 divided by 200, that simplifies to 1/2. That means 1/2 of every payment is getting his principal back. That means the other half, or 4,000, is going to be subject to tax. Okay. Luckily for your test, you don't need a calculator for this particular question. If you do need a calculator, there is a drop-down calculator on the screen. Because the computer you take for your license exam is on, the test you take for your license is going to be computer. And like I said, there's a drop-down calculator on the screen. Okay. Jennifer has reached a time in her life where she wishes to begin receiving payments from her tax-deferred annuity. Her agent has suggested she take the money out by means of a life income with 10-year certain option. When she does, the insurer will make payments for, 10 years or until she dies, whichever occurs last. Okay, so life insurance, 10 years, 10 years certain with life income. So we're going to pay her for 10 years until she dies, whichever occurs last. So if she dies within the 10 years, her beneficiary will receive money to the end of the 10-year period. But if she outlives the 10 years, we'll still pay her for as long as she lives. Okay. Annuities. There's different ways of buying the annuity. Bless you. You can single premium buy it, or you can do a flexible payment program. Now, if you single premium purchase this thing, you can immediately annuitize and start taking payments. Now, an immediate annuity means you're lump sum buying this thing, and within the first year, you're starting to take payments. A deferred annuity is when you, after 1 year, you start taking payments. So if you single premium buy an annuity, you can immediately take payments, or defer it or postpone it until after a year and take payments then. A flexible payment, you can't make a $50 payment and immediately, tell the insurance company to give you payments from that. $50 isn't going to last long. So a flexible premium or flexible payment annuity, you have to defer it. You have to build up an estate before you can annuitize and start liquidating it through periodic payments. Remember, annuities are not designed to pay lump sum. Okay. Now, with insurance companies, we have two accounts. The general account, think of fixed products, whole life, universal life, fixed annuities. And then we have the separate account. And whenever you see separate account, think of securities products. And notice the word variable, variable, variable. Variable life, variable universal life, and variable annuities. So anytime you see the word variable, that's a separate account. Those are securities products. So your money goes into the insurance company, into either the general account or the separate account, and into the investments, okay, or the interest that the contract is being supported by, okay. So those are the two accounts that you need to be aware of, okay. An annuity, which may be used to help fund retirement in a few years, maintains a separate account. The owner purchases accumulation units, and this is called it's going to be variable because the money goes in the separate account. So when you buy a variable annuity, during the pay-in phase, you're buying accumulation units. And then when you annuitize and you start taking payments out, those accumulation units will be converted to annuity units. Right? And so, again, anytime you see separate account, anytime you see accumulation units or annuity units, they're basically referencing a variable annuity. Okay? So some keywords for you. Which of the following is true about a service provider as it relates to health insurance? Whenever you see service provider, service plan, or benefits paid on a service basis, it means the payments are made directly to the provider. That means you go into the doctors and the hospitals and you get the care that you need. Right? Doctor's going to give you the bills, you fill out the claim form, you send it to the insurance company. The insurance company pays the doctors and hospitals directly for the care that you got. That's a service plan. Okay. Now we have reimbursement or indemnity programs where the insurance company gives you a check either to reimburse you because you've already paid the doctors and the hospitals, or they give you the check so that you now have the money to pay the doctors and the hospitals. Some companies give you a choice in the claim payment, and this is called an assignment. In health insurance, you can assign your claim payment. Okay. From the items listed below, choose a characteristic not found in the HMO's gatekeeper system. This is one of those tricky questions where you're not sure what they're even asking, and then you're even less sure of why this is the answer. In an HMO, we have a gatekeeper. It's called a primary care physician. It's just a general practitioner. So what's happening here is you sign up with an HMO, and you're going to pick a primary care physician called a gatekeeper. So when you have a problem, you typically go to the HMO, you go to that gatekeeper. They're going to review your situation, and then they may refer you to a specialist if they feel you need it. And so this is unique to an HMO system. And so the question says, which is not found in the HMO system, and that see that there is no provision for a gatekeeper. Well, that is not found because there is a provision. So you have a negative in the question and a negative in the answer, and that's what cancels each other out. That's what makes this somewhat difficult at times because you're trying to figure out what the hell are they asking, okay? So this is an example of a really good double negative question. It's not all in the question, like which of the following is not incorrect. You have a negative in the question, negative in the answer here, so, okay. PPOs are an offshoot of the HMO system. Which of the following is false about a PPO? And they're all false. With a PPO, we have a list of doctors in the hospitals called in-network. And if you go to the people on the list, it's actually cheaper for you. But if you have a doctor or hospital that's not on a list and you still want to go there, you can. It's just going to cost you a little bit more, okay? And so that's called out-of-network. The cool thing about a PPO is whether they're on the list or off the list, you can go there and we still help pay. It's just cheaper if you stick to the ones on the list. Okay, so it's kind of different from an HMO because HMOs, we don't have specialty physicians. PPOs, we do. Okay, HMOs are the most restrictive. PPOs are liberal. You can go to the ones on the list or you can go to someone who's not on the list. Either way, it's just cheaper if you stick to the list. All right. Select this statement that best describes a multiple employer trust. Well, when you see trust, think of a separate legal entity. Okay. So the answer here, it's a group of small businesses that band together, in a sense, in order to qualify for group insurance benefits. The funny thing about MUTs is you can't form a group just to buy insurance. You're forming a group, in a sense, to promote your business and in the process pick up insurance. A very good example of this would be your local chamber of commerce. All right. So where we get all these small businesses in a local area, they form a group to promote their business, and in the process, the chamber may set up a group insurance program for their members. Okay, so they didn't form a group just to buy insurance; they form a group to promote their business, and in the process, they're going to pick up insurance. Okay. Which of the following is true in regard to health insurance issued on a group basis? And in a non-contributory plan, all eligible employees have to be part of the plan. This is for group life and or group health. Whenever you see non-contributory, you have to have 100% participation of your eligible employees. That means after they've been there 90 days, right, they're full-time. Non-contributory means you're going to set up a group insurance program where the employees don't have to pay premium. And so when you see, the key words are when you see non-contributory associated with 100% participation. If you see contributory, that means the employees share in the cost of the premium. You got to have at least 75% of your eligible employees on the plan. Okay, so non-contributory equals 100%. Contributory equals 75%. That's how you need to know that. Grace period. Well, after your premium due date, your clients have a period of time to read the contract. I'm sorry, after your premium due date, your clients have a time to pay the premium because they're late and still keep the policy on the books without another medical exam or without a late fee. In life insurance, the normal grace period is 30 to 31 days. If your clients suffer a loss during the grace period, they're covered. If they don't pay the premium by the end of the grace period, then their policy will lapse for non-payment of premium. So for life insurance, like I said, it's 30 to 31 days. On the right-hand side for disability, which is also health insurance, the grace period depends on how often you pay the premium. So if you pay your premiums weekly, it's a 7-day grace period. If you pay your premiums monthly, it's a 10-day grace period. But if you pay your premiums quarterly, semi-annually, or annually, it's going to be a 31-day grace period. Okay. And again, if you suffer loss during the grace period, you're covered. If you don't pay the premium by the end of the grace period, your policy will lapse for non-payment of premium. But at the bottom of this chart, you can reinstate that policy. In either either life insurance or disability or health insurance, you can reinstate by doing 4 things. Number 1, you have to apply for reinstatement. Number 2, you have to pay all the past due premium plus interest on that past due premium. And you're going to have to go through a medical exam, which is evidence of insurability, because if your situation changed, we may not want you back. Okay. But if you do qualify, you can reinstate a policy that you let lapse for up to 3 years. That's on the bottom right-hand corner. Okay. So it may be beneficial to reinstate a policy versus buying a brand new policy. When you reinstate a policy, those lower premiums that you were paying when you were younger, when you first bought it, you go back to that. Versus buying a brand new policy today, well, you're older, so your rates are going to go up. Okay, an older policy, in an older policy, if it's past 2 years, the suicide and incontestable clause will typically no longer apply. But in buying a new policy, you got to wait those 2 years. Okay, the longer you keep a life insurance policy, the cheaper the loan rates are. So it might be, again, beneficial to reinstate an older policy, even though you have to pay all the past year premium, versus buying a newer policy with higher rates. Okay. If the premium on an individual health insurance policy is paid annually, semi-annually, or quarterly, what is the minimum grace period? Well, that's 30 to 31 days, because it's an annual health insurance policy. Okay. You may get the long version of that. A disability policy is issued and the premiums are paid on an annual basis on the 1st of January. At the first anniversary, the insured decides they do not want to renew the policy and they do not pay the premium. On the 8th day after the policy due date, the insured submits a claim for medical expenses. How will the company respond? Yeah, they're going to pay it because it happened during the grace period. Okay. So if you cancel a policy, there is no grace period. But if you just let it lapse for non-payment, then you have the grace period, then you have the possibility of reinstatement. Okay. The insurer can change the premium, assuming it is changed for all insureds in a class. However, the company cannot refuse to renew the policy or cancel it. This is an example of guaranteed renewable. So guaranteed renewable, you're guaranteed to renew if you pay the premium. It's just that on renewal, you're older. So the rate's going to change, it's going to go up. So guaranteed renewable, just pay the premium, you continue coverage, but the rates go up on renewal. Non-cancelable, the bottom one, non-cancelable, as long as you pay the premium, you have the coverage. The company cannot change the rate and they cannot change the coverages. Okay. So in both guaranteed renewable and non-cancelable, all you got to do is pay the premium, you have the coverage. The difference is guaranteed renewable, they can raise your rates. Non-cancelable, they cannot. Okay. So some other things to know: coordination of benefits. Let's say we have a husband and wife, and they work for 2 separate companies. They each have health insurance with their company. They're each going to name their significant other spouse as a dependent. Right? So a husband has health insurance with his company. If the husband's injured, his company's insurance will be primary for him, and then her insurance will be secondary, filling in the gaps. Likewise, if she suffers an injury, well, then her company's policy will be primary, right? And then his company's policy will be secondary, filling in the gaps. That's if there's any gaps. And so that's how you want to know the coordination of benefits is for dependent coverage on a group program. One of the questions will ask you, which of the following defines the coordination of benefits provision? And don't pick the answer where you have one person that has 2 jobs and they have health insurance at both jobs. That's not what we're talking about. Okay, this is where you have a couple and they're naming each other as dependents. So which is primary, which is secondary? That's what they're looking at. Okay. Consolidated Omnibus Budget Reconciliation Act. That's what COBRA actually stands for. COBRA is continuation of health benefits only. You can only COBRA your group health insurance. You cannot COBRA your group life or your group disability income. So COBRA, let's say you left the company for whatever reason, quit or got fired. All right. Now, when you leave the company, we're going to notify you that you may be eligible for COBRA. Now, if you do sign up, you have to sign up within 60 days of being notified. Not 60 days from being terminated, 60 days from being notified that you're eligible for it. So if you sign up for COBRA, you're going to pay your individual portion of the group premium plus up to a 2% admin charge to keep you on the plan. Okay. COBRA will let you stay on as a dependent on this program, or stay on the program for 18 to 36 months, depending on why you left the group. Okay. Now, since it's a federal program, it's for employers that have 20 or more employees. You're required by federal law to offer continuation of health benefits. But California, we have CalCobra, and it's for the smaller employers. Okay, so the employers that have 2 to 19 employees. So it pretty much encompasses the rest of the businesses that have employees, and they are required to offer continuation of group health benefits. Okay. Health insurance. Okay. So in all cases, really, when you leave a company, you're eligible to continue the group health insurance by paying the premium. It's transitional. Reason it's 18 to 36 months because, well, hopefully in that time you get hired by another company and get on the other group program. Okay. So in any case, if you leave a company, you're eligible for continuation of health benefits except one. Termination for gross misconduct, you're not eligible for COBRA, either CalCobra or the federal COBRA. Okay. So we caught you stealing in the office, we terminate you. You're not eligible for COBRA. That's gross misconduct. Okay. Arnold and Bertha are married and work for different firms. Arnold has group health insurance through his company that also insures Bertha. Likewise, Bertha has group health insurance also covering Arnold. Select the correct statement below about how benefits are affected by the coordination of benefits provision in both plans. If Bertha files a medical claim, Arnold's company will be secondary. Because remember, Bertha's will be primary, his is secondary. That's what coordination of benefits is about, dependent coverage. So the inability to perform the duties of any occupation for which one is suited by reason of education, training, experience, or prior economic status. This definition of total disability and a disability income policy is going to be, well, before we go to this answer, in the question it says, inability to perform duties of any occupation. And so that tells us it's an any occupation definition. And any occupation definition is more restrictive. So remember, Social Security's total disability is the most restrictive. Any occupation is very restrictive. That means if we have a $200,000 a year neurosurgeon, they get into an accident, they have a pinched nerve, cannot perform neurosurgery. If they can still maybe go on tour and give lectures and educate other people about it, so they can still make money with their background, then this policy won't pay. So they can still perform any occupation with their background and experience. So it's very limited, very restrictive. The other definition is own occupation, and this one's a liberal definition. So again, if we have a $200,000 a year neurosurgeon, they get into an auto accident, they have a pinched nerve, and they cannot perform neurosurgery anymore, this policy actually will pay because they can't do their job anymore. Even though they can do something else, they cannot do the job that they were working at. So the own occupation definition is extremely liberal. Okay, so if they change this question to own occupation, okay, then it would be 2 and 4. All right, so read the question carefully because it does change. Hospital confinement or hospital indemnity, or sometimes called hospital income policies, pay a daily benefit for every day that you're confined in a hospital. This is what we call a cafeteria plan. It's a little add-on, can be added to your employer-sponsored program. Can be paid by the employee. The employer is just offering some additional benefits through an insurance company. And so it pays like, I don't know, between $300 to $600 a day because you're in a hospital. Okay. Which of the following is not a feature of a major medical insurance policy? Capitation. Anytime you see copay or capitation or gatekeeper, that's an HMO. Major medical policies have deductibles, coinsurance, which is at 80-20 cost share, and again, maximum benefit amounts. Okay. Some other terms to know. Yeah, acronyms. One of your test questions says, or may ask you, what does MRMIP stand for? And it's Major Risk Medical Insurance Program. Now, it's a California program. It's funded by tobacco tax in California, and it's basically allowing people to set up a state-sponsored insurance program that covers pre-existing conditions. Okay. Now, the PCIP, Pre-Existing Conditions Insurance Program, that's the federal program. Kind of the same thing, but that's the federal level. Medical loss ratios, or MLR. Because we have the national health care, insurance companies are kept from overcharging the consumer and making too large of a profit. So if a company makes too much money, all right, they actually have to refund that money back to the policyholders in the form of a rebate. Okay. So, and that's what the medical loss ratios. If our loss ratios means we take the claims that we pay out divided by the premiums we take in. So, yeah, if we're taking in too much premium, we have to refund that money back to our policyholders, and it's called a rebate. Okay. PPACA. This is the Affordable Care Act in a nutshell. This allows children to remain on as dependents until age 26. Anyone who's disabled as a minor can stay on as a dependent forever. But the PPACA has 4 metal plans. We have the bronze, the silver, the gold, and the platinum. And so the one you typically want to know, well, you might get 2 questions. Number one, which of the following is not one of the metal plans under the PPACA? And anything outside of bronze, silver, gold, and platinum, okay, would be the answer. But what it is with these programs, the government helps subsidize the premium. And the most common test question you're going to get is under the gold plan, which of the following is correct? And that the government subsidizes 80%. So if you see 80%, look for gold, or vice versa on the Affordable Care Act. Healthy families, this provides medical, dental, and vision for children. Okay. No children left behind. ADA is Americans with Disabilities Act, and so the test questions may ask you which of the following is a disability under the ADA, or which of the following does not classify as a disability under the ADA. Okay. Versus ADLs, which is activities of daily living, and that would be triggers for long-term care benefits. So you got to know the difference. For long-term care, activity of daily living is you need help eating, dressing, bathing, walking, going to and from the toilet. So you cannot do normal routines of everyday life. That would be a trigger for your long-term care policy to pay benefits. Being blind is a disability, but not an activity of daily living for long-term care. Because being blind, you can still function. Okay. Alzheimer's is a trigger for long-term care benefits, but it's not a disability. Okay, so the test is going to say which of the following is or is not a disability, or which of the following is or is not an activity of daily living for long-term care policies. And so you need to know the difference between the two. The next one is medical. Anytime you see medical, just think health insurance that anyone buys. Medicare, we talked about, senior health care through the Social Security program. And then we have Medi-Cal in California. It's typically called Medicaid in pretty much all the other states. And this is a healthcare, socialist type healthcare provided by the state and federal level for people who cannot afford it. Medically needy, medically indigent individuals that can qualify because they've their poverty level. So it's healthcare for people who normally cannot afford it. This is like the government catch-all, the last resort. So if you cannot afford health care, you're not on the senior program, apply if you qualify. Then the next is a government program, which is the Medi-Cal or Medicaid program. Okay. So again, look for medically needy, medically indigent. It's very common for the test question. Low income, under age 21 or over 65. Okay. So the major risk medical insurance program, that's at MRMIP. Right. Again, you may get a question, what does MRMIP stand for? And there it is. Okay. So it is funded by the state of California and tobacco tax. And so we're paying for helping pay for medical expenses for people who do not have health care that have a pre-existing condition. When do benefits begin under the MRMIP? Well, when you register under MRMIP, you're placed on a waiting list. Okay. So it's not immediately you put on a waiting list. The Family Medical Leave Act, another federal acronym here, okay, provides for what minimum amount of unpaid leave. And under the Family Medical Leave Act, you get 12 weeks of unpaid leave per year. This is for people to take time off from work to have a baby, take time off from work to adopt a child, take time off from work to help a family member with long-term care needs, take time off from work to deal with your own medical because you already used up all your sick pay and vacation pay and you need time off, you can't work. This is 12 weeks of unpaid leave every year that you qualify for. Okay. Now the test may go the opposite route. How many paid weeks do you get per year? And that's actually 0. If it's 12 weeks unpaid leave, then it's 0 weeks paid. Okay. So again, this is another one of those tricks that the test throws at you, because in all your studies, family medical leave is 12 weeks unpaid leave, 12 weeks, 12 weeks, 12 weeks. And then they go take the test and says, how many paid weeks do you get? And you're focused, well, there's family medical leave week, you pick 12 weeks. But it's actually 0 paid weeks because it's 12 weeks unpaid. So read the questions carefully, folks. It's just designed for you to trip up. Which of the following is not a physician? Well, everything else is ologist, optometrist. So yeah, that kind of stands out. But I know when you're taking your test, you're kind of stressed out. You got that test anxiety. You can't think straight. So through repetition of my questions, I mean, if you go through it over and over again, when you go take the test, you'll recognize it and you'll know. Okay, so optometrist is not. A measure for rating an individual's need for long-term care benefits is, and that's that activity of daily living, or ADLs. The magic number is 2. That's another test question you may get. You'll get 4 questions on long-term care, just like 4 questions on riders, 4 questions on annuities. Okay, so the magic number is 2. If you cannot perform 2 activities of daily living, that would be a trigger for your policy to pay benefits. All right. So the federal program, the tax qualified program, which is regulated by the federal government, there's 6 activities of daily living. The non-tax qualified program, which is state regulated, there are 7 activities of daily living. But in either case, if you cannot perform 2 of the 6 or 2 of the 7, that would be a trigger for your policy to start paying benefits. Okay. Viatical or life settlements are accomplished through the use of absolute assignment. So what's happening here is you have a life insurance policy and you're diagnosed terminally ill. Now, let's say you have 2 years left to live. Now, if you have an accelerated death benefit rider, which gives you an advance on the face amount, that's good if you have 6 months to a year left to live. But I just said you're diagnosed terminally ill and you have 2 years left to live. That means you got to wait 1 year before you can get an advance on the face amount of your life policy to cover your medical. But rather than wait that time, well, sell your policy to a life settlement company. So if you're diagnosed terminally ill, well, they'll give you basically buy out the face amount of your policy at a discount. They give you a percentage of the face amount of your policy now, and then you transfer ownership of the policy to them, and they now own a policy on your life. And when you die, they get the face amount. So they get the face amount minus what they paid you, right? And minus any premium they paid till you pass away. That gap, that difference, that's their profit. So they're investing in buying this asset from you. People don't realize life insurance is an asset, and in the time of need, you can sell the asset for money. Just like buying a house, you can sell the house if you need money. Well, you bought a life insurance policy, you can sell the life insurance policy if you need money. And when you transfer the ownership of the policy, this is called an absolute assignment. If you do get that test question, C, collateral assignment is like using your policy as collateral to secure a loan. All right, that's what a collateral assignment is. It's a temporary or partial transfer of the ownership rights. Absolute assignment is a complete, total transfer of the ownership rights. Viatical or life settlements are basically, you might get this, it's a rare question. This is the secondary market for life insurance, is viatical or life settlement arrangements. The secondary market for life insurance. Most people don't even know this even exists. Buying policies for terminally ill patients. Okay. Tax laws have established a modified endowment contract, or MECs. Select the correct response. And taxing the living benefit of a MEC is not like a non-MEC. So modified endowment contract is you have a life insurance policy, it's a permanent policy, and you kind of paid too much premium where you overfunded it. So life insurance is usually after-tax money, tax-deferred growth of the cash value, tax-free loans and withdrawals from the cash value, and an income tax-free death benefit. Great. But if you overfund your life insurance policy and it's classified as a modified endowment contract, you lose some of those tax advantages. It's still after-tax money. It's still tax-deferred and growth in the cash value, but now your withdrawals are going to be taxable. And if you're under 59.5, you also have a 10% federal penalty. So it's kind of a penalty for overfunding your life insurance policy. Okay, that's what a modified endowment contract is. If a policy contains benefits for community-based services or home care, it must also cover, it's actually all of them. So if you have a long-term care policy and you have the home care program, it has to come with hospice care, home health services, respite care, adult day care, right, personal care, and there's one other one. There's 6 items: adult care, hospice care, respite care, home health services, personal care, and home health visits or home care services. Those are the 6 benefits that are required to be on a home care, long-term care policy. Okay. You need to know the definitions, like hospice care is for terminally ill. Respite care would be giving the daily caregiver a break. So let's take you're taking care of one of your parents 7 days a week, 24 hours a day. How about you send them to a nursing home for a week to 2 weeks so you can have a break? That's what respite care is. Adult daycare, well, you're taking care of one of your parents at home 7 days a week, 24 hours a day. And drop them off at daycare on your way to work so that you can go earn a living and then pick them up on the way home. That's what adult daycare is. It's daycare literally, but for your parents rather than your kids. Okay, so you kind of need to know those definitions. All right. Industrial life insurance, we kind of talked about this way back in the life insurance section. This allows anyone from having more than $10,000. So the maximum face amount of an industrial life policy is $10,000. But your test might say the aggregate face amount of an industrial life policy is $10,000. But even though the maximum you can buy is $10,000, most people only purchased $1,000 to $2,000. That's a normal range. Some other topics: the California Life and Health Insurance Guarantee Association. It's run by a board of directors that are approved by the commissioner. Just like a bank, if a bank goes under, they have member FDIC to protect the policyholders or account holders in the event of insolvency of a bank. Well, in our industry, we have the Guarantee Association, which protects our policyholders in the event the insurance company goes bankrupt at the time that they suffer a loss. The maximum we're going to pay is 80% of the face amount, up to $250,000 for any one life. Okay. One other thing about this is in advertising, marketing, or selling your products, you cannot basically disclose the membership or use the membership of a guarantee association as an enticement or an inducement for the sale or purchase of a policy. You can't say, hey, you should buy from our company because we're backed by the Guarantee Association, because it's misleading, because every admitted insurance company has to be a member. So your company's not special. And if the company goes bankrupt at the time of the loss, you can't say, oh, man, you should buy from our company because if something happens, our company goes under, you're fully guaranteed. Well, no, you're not. We only pay 80% of the face amount, and it's a maximum of $250,000 for any one life, so you're not fully guaranteed. So do not use the existence of a guarantee association as an enticement or an inducement for the sale. Now, when someone buys the policy, there is a disclaimer about the Guarantee Association and its limitations, but that's after they bought the policy. HICAP, Health Insurance Counseling Advocacy Program. This is a toll-free info line for seniors to call if they have any questions regarding senior health coverages. They have volunteers. They go through rigorous training, and they answer seniors' questions regarding senior health products like Medicare, Medicare Supplement, senior HMO, and long-term care. Since they're volunteers, they do not sell or endorse any products. They can give you some legal assistance with claims, but that's about it, and it's free. It's a free program. It's not based on ability to pay. It's a free program. Basically, it is counseling. Okay. ERISA, Employee Retirement Income Security Act. This is a federal act that oversees your qualified programs like your 401k at work, your tax sheltered annuity, or 403b. KEOS, which is for self-employed individuals. This makes sure that the qualified programs that are offered, the plans are in writing so people know that there's a plan. And ERISA looks out for the benefits of the employees and their beneficiaries. So it's not looking out for the employers that are providing the programs. ERISA looks out for the consumer engaging in the plan. So it looks out for the plan participants and their beneficiaries. Okay. If you have both a life and disability license and a property and casualty license, and this is called having a concurrent license. And you can get both licenses, which allow you to do all of it. If you did already pass one of your tests and get fingerprinted, when you pass this next exam, you don't have to get fingerprinted again. They'll just attach it to your other license, and you'll have the same license number, but it'll allow you to do multiple things. So with that, again, I want to emphasize, if you have not registered for my online study with my sample test questions, reach out to me. These are the instructions of where to go to register. But if you do have questions, email me or call me, and so I can guide you in registering and accessing my material and how to study. If you follow my instructions, your study time is cut down dramatically in preparing for this exam, and your success will go up in passing it. So at this point in time, I'm going to open up to any questions. Okay, and let me unmute everybody here. Everybody still there, hanging in there?
Yes.
All right. So anyone have any questions? That's a lot.
Right.
Half of it is I don't need, right? Taking life.
Yeah.
So that question I asked you earlier, you answered it, which was like common sense, like there.
Okay. No, you were talking about the coordination of benefits provision.
Well, there's term universal. So just.
Oh, keep it simple. There's temporary
Correct.
and there's permanent. Temporary is term.
Right.
Permanent depends on the client. The whole life is everything's conservative, very conservative, fixed, set in stone. Universal is a whole life policy with flexibility.
Like
And variable.
30, whatever.
Yeah.
Okay.
And then variable is more the cash value. Well, actually, the permanent policy is whole life, universal life, variable life. The cash value grows at different rates depending on the suitability of the client, how much risk they can handle.
Got it. Okay.
Okay.
Got it. Thank you.
Natasha, any questions?
No, I'm just going to study. I kind of knew some of the stuff, so yeah.
Good. So it reinforces it. That's good.
Yeah, so I'm going to just take it and start doing the quizzes.
Okay. Good.
On your website.
Good.
Because I take my test on the 17th, I believe. Yeah.
Oh, plenty of time. Wednesday the 17th. Good.
Mm-hmm.
Yeah. Actually, a couple of weeks ago, I tutored 3 people on a Sunday afternoon at Starbucks in Brentwood. 2 of them passed the next day, and the third one took it on the Wednesday right after and passed.
Oh, great.
And they didn't look at my website until after they met with me.
Mm-hmm.
So cramming on a Sunday, taking it the next day they passed. So yeah, that's actually not bad.
Right.
That's what I'm doing, Natasha.
Right.
I'm actually taking mine tomorrow, so wish me luck.
Good luck, girl. You gonna do it.
Thank you. You will too.
All righty. Thank you.
All right. So with that, we'll go ahead and end this webinar.
All right.
I'm going to post it. Let me actually end the